session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market?
There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Last night we were at a dinner at a restaurant, and as we were walking out, a man walked over to me and said, "Thank you very much, you paid for my daughter to go to college." And basically I get that all the time. It's the most unbelievable thing. That's my job.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The growth story in cannabis remains very strong even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
It did make sense earlier in the pandemic to give us time to prepare, to do surge preparedness, to identify testing strategies. I'm not sure if it does make sense anymore, especially when there is so much other travel happening around the world.
Bhakti Hansati there, Johns Hopkins Associate Professor of Emergency Medicine on travel bans around the world. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here's your equity market, a price action. We're down 12. We're negative 1/3% on the S&P off the back of about 3 days of losses. Really, really marginal days of losses, including what was Friday, negative 0.03%.
Yeah,
something like
huge,
that.
Massive.
I know, Tom, huge. Yeah. Yields in a massive single basis point to 132.24. And euro dollar going into that ECB decision a little less than an hour away now. Euro dollar 118.32, positive there, a little more than 1/10%. TK, have you seen the rents in New York City? Here's some data for you. Miller Samuel and brokerage Douglas Elliman putting these numbers together for us. 8.1% in August year over year if you have a doorman. If you do not have a doorman, the rents for those units fell 12% year over year in the month of August. So if you have a doorman, we're up 8. If you don't, we're down 12. What do you reckon that's about, TK?
I don't know. You know, the walk-up that I'm in, I really don't worry about it. But, John, I do think, and as I watch rents, the vacancies are gone.
Walk down.
They're just absolutely
given what happened with his elevator last week, it was a walk down.
Yeah, but, you know, the bottom line is rents are going up. That's all there is to it, John. And what I like about your numbers there, John, I don't think it's 2 or 3% lift. I think it's much more, and it really buttresses up against wage growth.
Well, if you have, Tom, do you think post-pandemic that you want the doorman because of deliveries, things like that? The convenience of it, the need to have it is that much greater now in the last year.
Yeah, I think so.
Security too. Do you think that speaks to that as well?
Yeah, and the bottom line is everything.
I don't know. I live in a walk up in Murray Hill, Tom.
I know you do.
You're in a fancy
Lisa's the
town
only
with a
one who's got
doorman.
the fancy thing going.
I'm looking forward to the NFL and the sports bars this weekend.
Jennifer Nuzzo's going, what in God's name are they talking about?
She's not alone.
Joining
Carry on,
us with
Tom.
Johns Hopkins Center for Health Security and to save us, Jennifer Nuzzo this morning. Jennifer, there is a reaffirmation that the pandemic is still with us. I was explaining to one of the offspring, it's like the 28th chapter of the plague, Albert Camus' wonderful book, where it just won't go away. How should we deal with this pandemic exhaustion?
Yeah, I mean, it is really exhausting, I have to say. Even, someone who lives in the data and sees every day why we remain concerned about it. It's exhausting, and people want to get back to living their lives. I completely understand that. I think we're getting closer, and the thing that we need to do, I say this every time I come on, but the thing we need to do to get closer to that end is to get vaccinated. There's still a lot of progress to be made on that front. We still have a lot of adults who are unprotected. We know that vaccinating adults protects kids.
Okay.
And then, there's still kids.
Jen, look, you're like one of the leaders in the nation on health security. What do we do to the unvaccinated? What is your policy prescription to provide incentives to the unvaccinated?
Well, I think the thing that's probably going to have the biggest impact is what's been going on. And businesses are rightly wanting to get back to business. They want to do so safely. They realize that their employees want to come back, their customers want to come back, and that the best way to make sure that happens safely and happens without further interruption is to require that their employees get vaccinated. Now that the vaccine is approved, at least we have one vaccine formally approved, I think it makes it easier for businesses to make that decision. And I think that's going to have a big impact in terms of vaccine uptake.
Dr. Nuzzo, John Ferro opened up this conversation talking about rents in New York City. It raises a question about the fate of big cities in an era where people are more concerned about variants of COVID that are never going to go away. Do you foresee a time when people will not be wearing masks and people will be operating the way that they did pre-2020 again in the next 5 years, or is that a pipe dream at this point?
Oh, I don't think it's a pipe dream. I mean, I very much foresee that. I mean, first of all, I think people are tired and they're not going to do it. And I think, we're getting closer to that point. I mean, one of the biggest things that vaccines do is they decouple the cases that we see from the deaths. And once we're no longer acutely worried about hospital systems being overwhelmed or people winding up severely ill or dying from this virus, I think the calculus of whether or not people need to wear masks changes. And I think that's going to happen sooner than we think.
Dr. Nuzzo, President Biden's going to be speaking at 5 p.m. today, giving a COVID speech, laying out 5 points of how we merge to the next phase of perhaps putting this behind us. What do you hope he says? What hasn't he said that's important?
Well, one of the things I'm deeply worried about is the erosion of testing capacities in the United States. We wrote an op-ed in the Times in March calling for this. So it's been many months. We saw that it was getting much, much harder to get tested. And while it was understandable, states had to kind of pivot from offering tests to offering vaccines. Tests were always going to remain important. And it shouldn't be hard for people to get tested, particularly if they have symptoms. They shouldn't have to spend hours, and they shouldn't have to wait. They shouldn't spend hours trying to find a place, and they shouldn't have to wait days to get their test results back. We haven't done enough with rapid testing. People want to be able to test themselves in their home, but they shouldn't have to pay a hefty price in order to do that. It should be freely and easily available. So that's what I'm going to be looking for. I also want to hear a strategy for how we're going to make sure everyone who needs to get vaccinated can. There's been a lot of confusion now about boosters, and what I'm worried about is that all the people who have great protection already are the ones who are going to be running out and getting more vaccines, as opposed to focusing on getting first and second doses into people's arms. That's what's going to get us out of this pandemic more so than third doses.
Jen, always good to catch up with you. Thanks for being with us. Jennifer Nuzzo there, Johns Hopkins Center for Health Security, senior scholar. I was looking at the Excelsior Pass. Here in New York State, if you've been vaccinated here, there's a pass on your phone. You can download it, readily available to everybody here. Lisa, mine expires on the 16th of October. The 16th of October?
Yeah.
What's meant to happen on the 16th of October?
How would I know? I mean, that's
when
the thing.
When does yours expire? I think a lot of people.
I'll check. You have to give me a minute, and I don't think anyone wants
TK,
to...
when does yours expire?
February 12th, Lincoln's birthday.
So why are you February 12th and mine's October?
Mine is April 2022.
I have no
So you're
idea.
April?
Yeah, mine, I have a long...
That makes no sense at all.
Maybe it's because, you're British. Maybe it's discrimination.
You think so?
No, I don't.
But seriously, John, I'm out of touch on this, John. Let's cut to the chase. If you leave America now, John, and go to Heathrow, can you come back?
No, I've got to fly through Mexico or Turkey, Tom.
Okay, I'll ask the surveillance question. Why?
Don't know.
I just don't get it.
I mean, I've asked the administration, Tom, and they'll tell you science, and then you ask the scientists, and they'll kind of shrug their shoulders a little bit.
I'm baffled by the whole thing. I mean,
I'm not sure if you want me to get
everybody's
fired up
wearing
about that one.
like
He
we're
does.
97%
Sure he does.
vaccinated.
Tweak you on that.
Everybody's
Kinda like
wearing
you.
masks, and Greg Vallier's got like Florida's 54% vaccinated.
TK, you can go to the UK and fly back.
I can.
You've got a different coloured passport, which means COVID won't touch you when you come back to New York. It can't get you. Science. If you want to keep this going, futures down 12 on the S&P. We're negative a third of 1%.
The markets.
I could go so much harder on this. Yields in a basis point on a 10-year, 132.
He just doesn't want to talk Crystal
58.
Palace Tots.
You really want to go there, don't you?
It's a big deal. I mean, Ted Lasso's filmed at their
At Selhurst
stadium.
Park.
Yeah,
Euro
it's
dollar,
called.
118.31.
Bottling this up for 3 days.
Whatever it's called. 15 minutes away from an ECB decision. Tom thinks this morning is boring. He's been away the last couple of days.
It's
Tom,
like
that was
come
boring.
on,
Believe me.
You're ramping up the
Hey.
ECB. It's a snooze fest.
I had fun.
Did
Maybe
you?
I was alone.
Really? From New York. This is Bloomberg.
China has been focused for a long time now on catching up to the United States in space when it comes to space exploration, and they've really made a couple of really impressive achievements. For instance, in May, China landed a rover on the surface of Mars. It's only the second country after the United States to manage to do that. In June, China sent astronauts to its space station, which is still under construction. China is not part of the International Space Station because the United States worked to exclude China from that. But instead, the Chinese are working on their own. That's scheduled to be in full operation, I think, next year. The Chinese have really come a long way in space. That said, all of that's run by the Chinese government. There is a role for Chinese companies to play in the space program. They're not being as front and center, say, as Elon Musk with SpaceX or Jeff Bezos with Blue Origin. China's companies are playing a more supportive role, I think it would be a fair way to say it, working on things like satellites, rocket launch operations. They're leaving the really big, sexier items when it comes to space exploration, leaving those to the Chinese government.
Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early starts to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, we see the evidence of that strong consumer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can answer phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The story is going to flip in terms of profitability and inflation.
This is not a market of everything is going to go up, everything is going to win.
We're in a very low risk environment, and the feeling is you can buy practically anything.
When we look at consumer finances in general, there's still potential for the consumer to spend over time.
I think all those things point to an economic cycle that lasts just a bit longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The ECB decides this hour from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market down 12. We're negative a third of 1% on the S&P. TK, 4 days of losses on the cards. A monster move.
It's been a monster drawdown. We showed that last hour as well. I love that we had Ben Laidler, optimistic, John Douglas Cass watching. Good morning, Doug Cass. He's very cautious on the market. He looks for a market hurricane.
A hurricane. A hurricane. I don't know if the sarcasm didn't translate or not over Bloomberg Radio. They've been really marginal moves Friday, Tuesday, Wednesday, into Thursday. Tom, in about 45 minutes, the ECB joins in.
Yeah, you know, we've been making jokes about it, but to be honest, everybody's going to hang on every word of the press conference. I mean, the statement, you tell me, John, maybe it's in the margin. You're expert on it. I could care less. But the press conference may have some real value. She's got to change the dialogue in what way?
So at 45 minutes past the hour, we should get some understanding about the pace of purchases. Then at 30 minutes past the next hour, it's the news conference. And at the start of that news conference, Tom, you will get some forecasts. So the forecast could be interesting just in terms of what they do with their outlook for inflation.
We just had Jennifer Nirzawan, Johns Hopkins University, has an American conversation. The pandemic's no different over there. She's got to be pandemic affected.
So that's the story for the Pandemic Emergency Purchase Program. And the key here, Tom, is the E in PEP. It's emergency. Are we still in the emergency phase of all of this? Do we still need the program that big with that much flexibility in a moment like the one we're in right now? And Tom, I think that's the conversation they'll have within the Governing Council and no doubt in the news conference with journalists.
But I mean, Lister Man City this weekend, I mean, they're going to have 30,000 people in the stands,
You had to get there, didn't you?
No, but is that an emergency pandemic
It doesn't look
program?
like an emergency if the stadium's full.
Yeah.
In the UK.
I just don't get it. I'm lost.
Lisa,
in the
many
whole
people
thing.
don't get it. Are we still in the emergency phase of this pandemic? Can you justify the flexibility that program has?
I was in a restaurant last night, Lisa, over by you, and there's no emergency.
Well, perhaps not in a restaurant in New York City. The question is, what's the nature of the emergency? And right now, we're not just dealing with the pandemic of numbers. And in Europe, actually, I think that they've exceeded the U.S. when it comes to vaccinations at this point. But it also has to do with some of the supply chain kinks that are causing inflation to pick up and sort of the mismatches that you're seeing over there in the labor market as well. How do they bring it back? And what does the central bank, the ECB, actually do about that? How much does this PEP program really help that?
Lisa, did you see PPI in China?
Yeah.
Factory gate prices just absolutely surging.
The highest since 2013 years, I should say. And this really stems from the fact that aluminum is the highest that it's been in 13 years. You're seeing surging metal prices, and even though you've got authorities trying to tamp them down, it isn't working. And this does lead to, I hate to use the S word, but I mean, a stagflationary kind of feeling. Even if you get growth of 4%, 5%, it's not necessarily the acceleration that will sustain that over a longer term.
Aluminium, aluminium, I'm still practicing. Futures down 12. Thanks, Tom. Lisa missed it. We're down 12 on the S&P.
I didn't
We're off by a quarter of 1%. In the bond market, yields in a basis point. 132.58. On 10s this morning. Your ECB decision is 42 minutes away. Euro dollar 118.29. Lisa, that currency pair positive, a little more than 0.1%.
Yeah, and as you've been saying all morning, in 42 minutes, we get the ECB rate decision, which, of course, I'm watching. That rate decision will be the interesting part, but even more interesting is the 8:30 a.m. Christine Lagarde press conference. Very interested to hear how they talk about their balance sheet as a tool going forward. More than 8 trillion euros currently, all assets under the ECB's balance sheet. People expect the U.S. to continue and actually use the balance sheet even more going forward as a tool because we have such low rates. Does the ECB have the same capacity to do this, given some of the split politics of a continent that is not one united nation? Then at 8:30 a.m., we get U.S. initial jobless claims. The expectation is for 335,000 new jobless claims. Again, how much does this point to dynamism in the economy at a time when the job openings have surged to nearly 11 million, a record, an all-time high? Why does this persist? Why are there any layoffs at this point? Is this the quit rate going up as people see more flexibility and options, especially with their savings flush from some of the rounds of stimulus checks? And then at 5 p.m. tonight, President Biden's going to give a speech about COVID, laying out a 5-point plan, trying to discuss how to get to the next stage where we stop wearing masks and can actually re-engage with society in the way that we used to know it, John.
Lisa, thank you. Let's start right here with a story that developed in the last 24 hours. The title of the research, Should You Keep Dancing If the Music Slows Down? It was Bank of America, and here are the numbers. We mark S&P 500 21 target of 4250 by year end. That implies 6% downside from here, and launch 22 year end target of 4600, just plus 2% from here. This price target move to 4250 was from 3800 previously. Here's the line. Euphoric sentiment, margin risk, record duration pose additional risk. Own what's scarce, inflation-protected yield. I'm pleased to say that leading that team is Savita Subramanian of Bank of America, the head of U.S. equity and quantitative strategy, and she joins us right now. Savita, I'm interested in the process. You go from 3,800 to 4,250. Some people might call that capitulation. I'm not sure I'm in that camp. Just walk me through your approach to this market, to your forecast, with other people throwing out numbers like 5K for next year.
Sure. Yeah. The process is it's a disciplined process. So we have five signals that we look at, which range from things like sentiment to fair value, valuations, earnings revisions. Here's what's happened over the last few months. Earnings have come in much better than expected, and the market has basically doubled off of the COVID lows. So essentially, a lot of what we've done in terms of thinking about our target from here is how much good news is priced into the market, how much more can the market rise from these levels, or is there downside risk in the months to come? And I think that, part of what we're looking at is the idea that the market is essentially, the valuations of the market right now are leaving very little margin for error. Meanwhile, earnings have come in strong, but we're starting to see some harbingers of risk. And, everybody's talking about supply chain risk and inflation. We're actually starting to see that come in the numbers. So every month we track this guidance ratio. We look at the number of companies that are guiding above versus below consensus earnings revisions or consensus earnings estimates. Over the last, let's call it 4 weeks, we've seen that guidance ratio move from record highs to a big southward move. We're starting to see companies warn on profits, and it's showing up in a broader way across the S&P 500. So first of all, earnings are at risk from just a cyclical pressure of input costs, wages, supply chain dislocation, et cetera. Second of all, when you look at the secular pressures on margins, we've had this great period of time for the S&P 500 of globalization. The past 20, 30 years have been about U.S. companies getting more global, kind of arbitraging taxes, labor costs, et cetera. Now look what's happening. We're at peak globalization. We're starting to see companies onshore. And what that's going to do is, again, potentially stall or reverse this kind of long-term great theme that we've had for big multinationals in the S&P.
Savita, I want to pin you down on this. Partition for me the earnings dynamic, the nugget that we call earnings growth, the dollar amount of earnings of S&P index versus the partial differentials of price to earnings. Which of those dynamics are you focusing on with such a narrow call?
Well, I think it's more the PE that's making us think, okay, there's not a lot of upside from here. And I'll tell you one thing, Tom. So we have a valuation framework that's not very predictive over the near term, but it's kind of all that matters over the long term. The R squared on this framework is 80% in terms of explaining.
But can you, this is critical. I don't mean to interrupt, but this, folks, is math that's important. Is your R squared valid given the dominance of those gigatech companies?
Well, I'll tell you this much. It worked during the tech bubble. And this is an important point. I'm glad you brought up the gigatech tech companies, because the last time this framework was as negative as it is today was in 1999, another period where we were all kind of calling out the primacy of technology. And I think that today the bubble is potentially even more dangerous, because it's not about, growth stocks, where tech ultimately grew into its multiples. It's about bonds and interest rates remaining as low as they are for perpetuity. I mean, this is what scares me, Tom, is that the S&P 500 has essentially turned into a 36-year zero coupon bond. If you look at the duration of the market today, it's basically longer duration than it's ever been. So what that means is that any move higher in the cost of capital, be it interest rates, credit spreads, equity risk premia, that's basically going to be a huge knock on the market relative to the sensitivity we've seen in the past.
Savita, just real quickly here, you did upgrade your forecast, however. You moved up from 3,800. Why does this not become the bear case that you originally saw?
Well, look, I mean, I think that the market could move as low as 3,800 in the near term. But when we look at our frameworks and we think about, okay, points in time forecasts are fraught with peril. But I think, our view is, okay, earnings have come in a little bit better. Companies have been able to navigate a lot of the margin pressures. We're actually at peak margins today for S&P. So it's a pretty remarkable story that corporate America has been able to manage, the COVID-related risks as well as it has. But I think that now we're starting to see some of those areas fray, and we're sort of waiting to see how corporate America deals with it. What would make me more bearish and go back to 3,800 is if we see inflation persistent and dangerous and companies unable to pass any of it on through prices, and if we saw a more hawkish Fed. I think the other thing that we pointed out in our note is that earnings matter for the market, but post-crisis, what matters even more is the Fed. And I think, it's kind of remarkable. We have a chart in our note that shows that the Fed has basically explained half of the market moves outside of earnings since the global financial crisis. So you've got this market that's basically been fed by stimulus. We're now at a point where the Fed is talking about tapering. It's hard to imagine they're going to accelerate asset purchases. I mean, what gives? And, the valuations don't reflect any of this risk. So I think that,
I've only got 60 seconds left on the clock, but I don't want to leave you before asking, what do you want to own right now within this equity market, away from the index level stuff?
There's always a bull market somewhere, and what you want to own is the key scarce theme today, which is inflation-protected yield. So let's say the Fed keeps rates low forever, but inflation is starting to bubble up. Don't buy bonds. Bonds offer you a fixed coupon that's not going to keep up with inflation. Buy energy dividend yielders, buy financials dividend yielders, buy companies that are positively tethered to inflation and can pay a growing yield. I think that's the call right now, is really focus on income and inflation protection.
Savita, this was great. Can you promise me one thing? Next time you come back, let's get you together with Jonathan Golub, Credit Suisse again, and we can do a repeat. Let's do a repeat of that. Savita, it's good to catch up. We appreciate your time as always. Send our regards to the team. Savita Subramanian of Bank of America. Lisa, you say we just sit back. Believe me, the last time I did that, I did just sit back.
I know.
I just let them go.
You did a great job, and it was fantastic. And honestly, it's great to get both sides of the case, because frankly, this is the debate being had on Wall Street right now.
And Tom, away from the index level discussion, which is stunning to hear from Bank of America right now, there is a call within that to get long certain aspects of this market.
It's an absolutely original call, which speaks to how original the times are.
Very, very original. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro. Equity futures down 11. We're negative 0.25%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think it's unlikely that the Fed is going to hike anytime soon. And in fact, I would even argue that 2023 is too soon. But if they were to hike, are we ready for what's going to happen? What happens to asset prices and the feedback loop, therefore, into policy? So we are a bit stuck in a debt trap. And that's been informing our forecasts for a long time.
A punchy Steve Major, always punchy. Steve Major, HSBC's global head of fixed income research from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Here's the price action in the equity market about 20 minutes out from that ECB decision. Let's call it 30. Your equity market down 11. We're negative a quarter of 1% on the S&P. That's been a story the last couple of days. 3 days of losses, but really marginal moves. And the bond market yields lower by about a basis point to 133. TK, let's call it 133, 132.75.
John, if we get a 133 and Steve Major's saying 1%, you've been framing out 112. What's the ramification to the market if we get to 120? Is it good or bad for stocks?
Hello, traders.
Why do we get
I'm looking to trade euro, and I'm looking to sell short euro against United States dollar. The price I'm looking to sell 118.305. Okay. This is the price I'm looking to sell euro 118.30.5. Okay, if you're looking to trade euro, copy this trade and wait for other message, what I'm going to tell you, what's going to happen next. Okay, I'll speak to you later, guys.
At 1600 Pennsylvania, our Bloomberg White House reporter, thrilled he could step in this morning. Josh, we're going to get to 5 p.m. today. I want to cut to the chase. The White House and the unvaccinated. What can the White House, what can the president do unilaterally to affect, motivate, harm the unvaccinated?
Well, I don't know that he's looking to harm the unvaccinated necessarily, but he's running out of tools in the toolkit, that's for sure. We're going to see that big speech tonight. They're saying 6 planks of his so-called new strategy to quell the pandemic. Of course, they thought they'd quelled it. So what they kind of hinted at, and this is absolutely not confirmed, is that maybe they're going to expand vaccine mandates. That would probably be for federal workers, where Biden has the power to do that. They confirmed that their opinion hasn't changed, that they don't actually have the power to impose sort of widespread national vaccine mandates of any kind. What they've said is that these sort of like, they're hitting singles instead of home runs. These little incentives, whether it's an employer requiring it or a sports venue requiring it, et cetera, have been driving vaccination rates, and I think that's where they're going to hope to be.
And Lisa, just to explain that to you, that's what the Mets do. They hit singles and not home runs.
Yeah, and they don't hit any home runs, and that's why we end the season the way that we do. Josh, what kind of political support is he going to draw from Republicans, since a lot of the regions that are lagging behind with vaccinations tend to be red states, not blue states?
Yeah, I mean, it depends on the Republicans. Some Republican governors have been pretty out there in terms of calling for public health measures. Others have been obviously pushing against the tides. He's been sort of clashing with them on and off. That really does limit what the federal government can do, right? And so I think there are other powers, though, I think are going to have more questions than answers once we get past that 5 o'clock hour and past that speech. When are they going to authorize the use of the vaccine for children under age 12? It still looks to be weeks or months away from that.
What is that, Josh? What is the delay with the time frame there?
The FDA is still working on it. This is an age group that would probably get a look.
As you can see, it moved straight away down. So for time being, let's cancel this order. Let's see what's going to happen next. Maybe we'll put large order, so it was scared. We're scared. People who wanted to sell. For time being, I'm going to cancel the order to sell short. Let's see what's going to happen next. I'll let you know. Stay safe.
And they're preparing to start those booster shots September 20th. It looks like they're going to start with Pfizer only. Moderna doesn't have his ducks in a row yet, it seems. They're still, going through the process. So that booster question is itself raising questions, because you're putting shots in arms of all Americans, potentially even healthy younger ones that maybe don't need it as much, instead of shipping those abroad.
So meanwhile, the culture wars in the United States heating up, and I do think that this dovetails into the COVID story in a bit, because you have seen a split nation. The latest, President Biden is planning to sue Texas over this abortion law that's been very controversial at the Supreme Court. Didn't really weigh in on, and this basically is the strictest abortion law in the United States. Other states are thinking of following it. I believe it bans abortion after 6 weeks of pregnancy. What is the likelihood that he gains any traction? How much does it just harden the partisan lines in the nation?
I think it's definitely hardening the partisan lines. There's been substantial pressure on the Biden administration to do something, anything, even if it is sort of Hail Mary type legal action. I think we don't really know yet what the fate of that will be, but the Supreme Court's ruling puts Texas on pretty strong footing. Of course, that 6-week timeline, many women don't know they're pregnant until 4 weeks after that. So that's a very small window. There are no exclusions. He was asked about cases, the governor Abbott in Texas asked about cases of rape, about whether there should be exclusions for that. And he said, well, we're just going to catch all the rapists, and Biden's been pushing back on that. So this is an issue where they are under pressure to do something, where the Democratic, base, for lack of a better phrase, is clamoring for them to just respond, do anything they can to expand access to abortions in Texas. And, but their options look pretty thin at the moment. So, I think they're sort of searching the cupboard, but it's looking pretty bare.
A really serious issue. A sense of the tone of the debate down in Washington, D.C. and beyond. Josh, good to catch up, buddy. Good to see you. Josh Wingrove there, Bloomberg White House correspondent. Some headlines coming from Jen Psaki, the press secretary, the White House press secretary, speaking to MSNBC this morning, an American broadcaster. Jen Psaki saying Biden to talk about vaccine boosters today. The president also to list steps to make COVID testing more available. So when the president does speak, the press secretary saying, Tom, that the president will talk about vaccine boosters and list steps to make COVID testing more easily available.
Okay, they're managing the message. I get it. What are they going to do to motivate the unvaccinated? Villiers nails it this morning.
What did he say, Tom?
Percent vaccinated in Florida, 50-something. It's even worse in Texas, 40-something. I mean, come on, there's 2 discrete Americas. What does he do to motivate the Southeast to get vaccinated?
Essentially what you're asking, Tom, and Lisa weigh in, is whether we can actually do anything think at the federal level, or if it needs to be done at the state level with the governors of Florida, of
Should
Texas,
they be able to get on a plane? I mean, I'm asking.
Well, I mean, honestly, and that actually, frankly, is how companies have responded. And I think that the answer really lies with the corporations. I believe there was a survey out on Bloomberg today showing that about half of all major corporations have had mandates for vaccinations. How much are airplanes going to be the new determinants of vaccination, basically saying you cannot board if you're not vaccinated?
You think that's where this could be going?
I think that's already where it's going, basically, that you have certain capabilities or certain privileges. And frankly, there has been no ban on that, right? And you would absolutely get potentially more consumers coming in if they feel safer. So at what point does that dynamic push people into getting vaccinated?
When does the president speak, Lisa?
5 p.m. today. 5
p.m. today, 5 p.m. Eastern time. You will hear from the president of the United States from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Equity futures down 11, 12. We're negative 0.25%. The Dow down 77. It's over. Bull market over, Tom.
Done.
On radio, on TV.
It's a correction.
This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide on TV, on radio. This is Bloomberg Surveillance, and here's the price action this Thursday morning. Good morning to you all. Equity futures down 11-12. We're negative about 0.25% on the S&P. On the Nasdaq, a similar move. A tough, rough time for the Russell more recently. The Russell down about 0.5%. On the small caps this morning, we're down about 11. That's the story of the equity market. Savita Subramanian making some headlines in the last 24 hours. An upgrade to her price target from 3,800 to 4,250. But Tom Key, did she sound bearish or what? About 30 minutes ago on this equity market.
Yeah, the major observation there, John, to be quick about it, is it's less about equity market dynamics and the Bank of America call wedded to Fed and bond market dynamics.
They're pretty constructive on the economy, just not constructive on this market right now. Switch up the board and get to the bond market, 2s, 10s and 30s. Your next stop for this market in about 15 minutes, an ECB decision. What does that mean for the European bond market? What's the spillover? How does it bleed into treasuries? Right now, 10s, 132.75. Yields in about a basis point. Similar move on 30s. Curve just a little bit flatter. 30s at 194.40. Steve Major of HSBC, he's making a call that we might not see a rate hike over at the Federal Reserve through 2023. What about the ECB? Let's finish on that. Switch up the board and get to euro dollar. For the ECB and Kit Jukes over at SocGen, maybe we don't see it for the whole of this cycle. For a whole generation again. Haven't seen one since 2011. Euro dollar right now, 118.30. Euro dollar positive, a little more than 0.1%. Tom, in about 15 minutes, we'll hear from the ECB and get an idea about the pace of purchases. Yeah. And then there's going to be this compare and contrast between the ECB and the Federal Reserve. A taper at the ECB, if you want to call it that, is not the same as a taper at the Federal Reserve. The ECB has this pandemic emergency purchase program alongside the asset purchase program. Let's talk about PEP for a moment. Has a defined package, an envelope of 1.85 trillion euros, and a loose little bit of calendar-based guidance as well, something the Federal Reserve does not have with open-ended QE, Tom. So it's worth just bearing in mind at the moment that if you use the word taper, taper at the ECB is something very different to taper at the Federal Reserve.
Yeah, we'll have to see what she says at the press conference. That's what I'm focused on.
I can see you're so excited about it. 8:30 Eastern on Bloomberg Radio. Only if you had a rest over the long weekend, TK.
He was walking up and down the stairs, the walk up.
Finished their summer reading.
Okay.
All children are accounted for.
Cool. Euro dollar, 118.30. Oh, what it's like over in the Tom Keene household. Let's get you some movers this morning. Here's Romain Bostic.
Hey, good morning, John. Let's see if we can perk Tom up here. A lot moving this morning, particularly here in the airline space. All the major airlines out with their periodic updates, Tom, and it's pretty much a story right now about a deceleration in bookings and an elevation in cancellations. Not looking good here. American Airlines, United Airlines saying that they're actually expecting total revenue to be down more than 30% in Q3 compared to 2019, the quarter in 2019, that 2-year stack that most of these airlines are comparing themselves to. American Airlines looking for about a 24 to 28% decline down quarter over quarter, and Southwest Airlines looking at about 18 to 20%. All of the airlines looking for a drop here in revenue in the current quarter based on that 2019 comparable quarter. And then you look ahead into Q4, JetBlue actually saying that not only is Q3 going to be bad, but Q4 looks like there's going to be trouble ahead, though it does expect some of the leisure travel around the holiday season to hold up slightly here. All of the major airlines here, United, Southwest, as well as JetBlue, Frontier, all lower here in the pre-market by a percentage point or more. Also in the transportation space, keep an eye on Ford. Those shares down fractionally here this morning. That company abandoning its operations in India. It's going to take a $2 billion charge. Basically, the company really got squeezed there. A real high tax base out there for corporations, combined with an affinity for lower priced cars by consumers. Ford just really couldn't make those numbers work in its favor. Flip up the board. Let's take a look at the retail sector. Biggest percent mover here, at least to the upside, is Lululemon. Shares up about 13% right now, a beat and raised quarter. They continue to be the juggernaut here in this space, strong pricing power, and they seem to be unaffected, or at least being able to navigate some of those supply chain issues. Macy's here getting an interesting upgrade. The share's up about 1% here. Cowen, Oliver Chen and the folks over at Cowen, who've had a neutral rating on the stock going back to 2015, upgrading here to the equivalent of buy. Tom, only 2 buy ratings now on Macy's out there based on this upgrade today. And then GameStop, those earnings have come and gone. Conference call lasted 10 minutes and Tom, yeah, I don't know.
Team meme coverage.
Team meme coverage.
Thank you, Romaine. Thank you so much.
Sure.
John Farrow, Delta out there, as Romaine mentions, all the airlines reporting, and John Farrow, Delta, saying, you know, August didn't happen, but there's a little bit of a comeback here.
Booking trends stabilized in the last 10 days. That's the headline that comes from Delta, Tom. This is after United Airlines in the previous hour said a deceleration in customer bookings in the last few weeks. So Delta at least seeing a little bit of stabilization, apparently, Tom, in the last 10 days.
Absolutely. When you are Deputy Director of Monetary Affairs at the Fed, you are known to write short, sharp notes. Seth Carpenter has been acclaimed at doing that across Wall Street for years, and he joins us for his first Bloomberg conversation as Chief Global Economist at Morgan Stanley. Seth, congratulations on your new position. You got to go fly fishing with Alan Zettner. That's the indoctrination at Morgan Stanley. I love the short, sharp note. Everybody calm down about inflation. Why should we calm down about inflation?
I think if you look at the details about what's really driving the inflation, there's lots of reasons to believe the inflation in physical goods really is being driven by supply chain disruptions. We've heard about that for a long time. I mean, when we talk to our equity analysts, it seems like most of those supply chains are starting to get a little bit better, and at best, you know, and at least not get any worse. And so that means that the price level increases for those physical goods should be coming to their end pretty soon. We think we've actually peaked in the US when it comes to inflation now, maybe a little bit later for Europe. But the point is, the price level for those goods affected has probably peaked. They're going to start to ease off a little bit. That's going to pull down inflation for the index overall.
It's maybe not a global question, but I have to go to America. John Farrow mentioning this earlier. Real estate, homes, rents fold into this call, certainly for G10 or maybe even G22. How does housing fold in to a subsiding inflation?
It is the force that's pushing in the opposite direction, especially here in the U.S. The Morgan Stanley team, you mentioned Alan Zettner, who runs U.S. economics for us, for a long time has pointed to a really bullish attitude we've had on commercial real estate, multifamily home sector. So strong rent increases really will help buoy those inflation measures. So you've got two forces pushing against each other. Rents are going to be creeping up, but we're going to essentially be where we were pre-COVID on sort of the underlying run rate on rent inflation. It sort of surged a bit coming out of COVID after some ups and downs. Now we're settling into, you know, fairly firm, fairly robust housing market. That's going to lift inflation. The reversion, though, when it comes to those consumer goods themselves, that's going to be the things that keeps inflation from rising further from here overall.
Seth, you said that inflation had peaked. Can you help me understand where we stabilize? Do we stabilize at a higher level than where we were pre-pandemic?
So I don't think so. And the one point we've been trying to stress to clients is there's actually two-sided risk. I find the story, the narrative to be inflation is high, it's probably transitory, but there's always the upside risk. And to be sure, we are in very different times, and anyone who has 100% conviction on the outlook is either lying to themselves or they're lying to you. That said, I think there is the chance of downside risk as well. So if you think of supply chain disruptions, if they get fixed sooner than we think, if some businesses have started to add capacity on the hopes of this COVID rebound, then you could actually see those prices fall more than anticipated. And so you've got two-way risk to the outlook for inflation. So where does it end? I think for the US, middle of next year on a 12-month change basis, you could be looking at 2%, could be a bit lower. That outcome, that possibility was highlighted in the minutes to the last FOMC meeting, where the staff forecast has their PCE measure of inflation going below 2% in the middle of next year. I think that's a realistic possibility.
Reminds me of that famous quote. What was it, Seth? I forget who said it. If you interrogate the data for long enough, it'll confess to anything. It feels like the moment we're in right now, doesn't it? If I look at the labour market, I can get this labour market data to tell me things are very tight. I can get it to tell me that things are very loose. When you look at it, what does it tell you?
So I look at a few things. One, I look at where are things happening. So decompose issues in the shortfall we had in last week's data, which was pretty surprising for us on the downside. A lot of shortfall in hospitality and leisure, not surprising. Ex post, not surprising. The Delta variant surging means that a lot of those industries, they're just seeing a pullback. We think it's temporary. We think Delta will have peaked and will come down, and the recovery will continue. But for me, that's one of the key points in terms terms of thinking about demand. On the supply side, I look at labor force participation, especially prime age labor force participation. It's been creeping up for the past 3 months. It's well below pre-COVID levels. I think there's every reason to suspect it will continue to rise over coming quarters and possibly even years if we get continued strong growth.
So if we just tie this all together, when you say that inflation has peaked in the U.S., do you include wage inflation in that, or is it entirely a supply chain story?
Very good distinction, very important distinction. I was talking about consumer prices there, and that's the part that's going to matter the most for monetary policy explicitly. Wage inflation is, in fact, a different phenomenon. I think one key point that gets lost, and you can look at some of the research coming out of the Fed from some of their top economists in the Research and Statistics Division, not a huge amount of evidence in the United States of this wage push inflation phenomenon. The link between wage inflation and finished consumer price inflation in the U.S. has actually been pretty weak over the past couple of decades. Wage inflation is clearly strong. There's been lots of disruptions there, businesses having to pay up to hire people back. I think we want to be very, very cautious, however, and look at some of the measures that do a better job of adjusting for composition, because, again, for the last employment report, we saw this big tick up in wage inflation. It was biggest in hospitality and leisure, which is also where we know the underperformance was. So when you're not hiring back the people who are at the middle and lower end of the income distribution, that calculated average hourly earning is going to get biased upward. So I think we want to be super cautious here about any sort of medium and longer term inference about wage inflation.
It was Ronald Coase, just in case you were wondering as well, Seth. Thank you. Good to catch up, Seth. Really good to hear from you. Seth Carpenter, Morgan Stanley, Chief Global Economist from New York. Your ECB decision is 4 minutes away. Full coverage right here on Bloomberg TV and on Bloomberg Radio. Equity futures, -12. We're down 1/3%. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Corporate vaccine policies show a stark divide over employer mandates. Bloomberg surveyed more than 100 big companies. About half have implemented a vaccine mandate for at least some of their U.S. staff. Still, requirements vary widely, and the planned post-Labor Day migration back to American offices isn't happening as planned. Ford is calling it quits in India after failing to make significant inroads in one of the world's biggest emerging car markets. Ford will shut down its Indian factories and rake a roughly $2 billion restructuring charge. About 4,000 employees will be affected. United Airlines has seen a big drop-off in passenger bookings the last few weeks, believed to be due to the spike in coronavirus cases. The airline now estimates third quarter revenue to be down approximately 33% versus the third quarter of 2019. United says it expects bookings will start to recover once COVID cases peak. Hackers were able to breach the United Nations computer network earlier this year, and they made off with a trove of data that could be used to target UN agencies. No word who the hackers were. They apparently gained access to the system using the stolen username and password of a UN employee. And for the first time, U.S. antitrust officials have made public the data they're using to help prove Facebook has a monopoly over social networking. The FTC revealed numbers that it says show Facebook is far and away the most dominant social network. The company has said that the case is without merit. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
I think the ECB may tap the brakes a little bit today, but I think they're going to be one of the last central banks to actually increase interest rates, and fiscal policy is going to remain pretty loose. So I actually think the next couple of years, European GDP could be on par or even outpace that in the US.
That's the call from Ben Laidler of eToro, the global market strategist from New York City this morning. Heard on radio, seen on TV. This is Bloomberg Surveillance alongside Lisa Bramett and Tom Keene. I'm Jonathan Ferro. That ECB decision is moments away. Here's the state of play in the market right now. Equity futures slightly negative off the back of 3 days of losses. Futures are down 14. We're negative about 1/3% on the S&P. Into the bond market with yields lower by about a basis point to 132.75. In the FX market, euro dollar positive. A stronger euro, Tom, 118.30. That ECB decision seconds away.
Yeah, the currency market is a litmus paper for the global system, really going nowhere over the last number of weeks. Maybe some fractional dollar weakness, but, you know, John, a 117, a 119 on euro, you wonder if you're going to see that. I don't think so.
I have no idea. 118.31 is where euro dollar is going into the decision. Yields in a couple of basis points on an Italian 10-year to about 73 basis points. Let me guide you through the next 45 minutes because this can get really, really messy and we'll work through it together. In about 10, 15 seconds, you'll get an ECB rate decision. Got to look for some guidance about the pace of purchases within the PEP program. Then at 8:30 Eastern time, so about 45 minutes from now, we'll get a news conference where we'll get some forecasts as well. So rate decision, we're looking for that to be unchanged. It is unchanged. Then we need to start to look for the guidance from the ECB too. So let's work through this together right now. 0 on the main refinancing rate of the ECB, the depot rate negative 50 basis points, the marginal lending facility at about 25 basis points, also unchanged. Then we get a whole bunch of headlines about the asset purchase program. So let's read out a few of them right now. They slow the pace of PEP. That right there is the headline we were looking for. The Pandemic Emergency Purchase Program, they slow the pace of it. Bear in mind the overall envelope is still 1.85 trillion euros. That's set to go through to March, but they're going to slow the pace of that program after ramping up the pace of it earlier this year. As I say, taper at the ECB is very, very different to taper at the Federal Reserve. There is still an envelope of 1.85 trillion to work through. They've got to about 1.3 trillion. Together with that, there is still an asset purchase program too. But that's the headline right now. They affirm the size of the Pandemic Emergency Purchase Program at 1.85 trillion, but they slow the pace of that bond buying. That package has a ton of flexibility. They slow the pace of it moderately. So they set a moderately lower pace for the pandemic bond program. I'll allow President Lagarde to go through the semantics. She will do that in about 45 minutes' time. In the bond market, what does it mean? I've got to say, not a whole lot. In the Italian bond market, we were down a couple of basis points going into this decision. We're down about a basis point now to 74 basis points. In the euro dollar right now, 118.35. That's basically unchanged off the back of this as well. So largely in line with expectations. So Tom, let's put this all together. Rates unchanged, the Pandemic Emergency Purchase Program, the overall size of it unchanged, but the pace of monthly purchases will slow somewhat.
Yeah.
What we need to ask going into the news conference, this is the question that's been outstanding for much of this year. When's the emergency phase of this pandemic over? Point one. And point two, if PEP ends in March, or perhaps earlier, I have no idea. If it ends anytime soon, how much flexibility from that program gets carried over to the asset purchase program? And beyond that, does the APP get a boost next year? A lot of that's going to be dependent on the forecast, Tom, that we get in about 40 minutes' time.
To me, the key headline, John, is out moments ago as you were speaking there on PEP, and that is inflation may moderately exceed goal for a transitory period. My answer is, what's the response of Bundesbank to the 47 headlines out there showing the first and second derivatives of a modeled program that's unchanged?
I don't want to preempt the forecast, Tom, but that's the headline, that inflation may moderately exceed the goal for a transitory period of time. Here are the forecasts going into this meeting. We get an update to these forecasts, as I say, I'll repeat, in about 30, 40 minutes' time. But the forecast going into this meeting, 1.9% for CPI this year, 1.5% for next year, and in 2023, 1.4%. was the forecast for 23 going into this meeting. So the news conference is going to be interesting for the forecast as well, Tom, and that's what this policy will hinge on going through to next year.
The dissent here of Bundesbank, which is unspoken, is tangible.
So we get to Maria in
Let's
Frankfurt.
Get to Maria. She knows more than I do.
Joins us right now. Maria, going into that news conference after this decision, what are you looking for?
Well, there's
there's two things, and going back to the point that Tom just made, the hawks make a lot of noise, and we've heard it from the Dutch, the Germans, the Austrians, but if you look at the language here, the ECB says it's transitory, the inflation picture. So it does show that at this point, at this stage, the Governing Council is still very much owned by the doves in that Governing Council. The other thing that will be key for the press conference is they've said we're going to slow the pace of the PEP program, but officials in Frankfurt speaking with me have told me that the key here is that Christine Lagarde will have to make it clear that this is not a taper. The reason why they're doing this is because the forecasts for the European economy are improving, financing conditions are improving. This is not a taper. That's a message that she will have to send in that press conference. This is very different to what the Fed is doing.
Maria, thank you so much. Greatly, I love that. John, would you translate what Maria just said? This is not a taper.
But people don't want to confuse this ECB decision with a Federal Reserve decision. Bear in mind that what the Federal Reserve is doing is open-ended QE, Tom, at 120 billion a month. What the ECB is doing is something very different. And you can imagine a situation where the ECB totally unwinds PEP, Tom, stops buying with all that flexibility, and boosts the asset purchase program next year. As I say, a lot of this is going to come down, Tom, to what happens in the news conference and the forecasts we get as well.
We are thrilled to provide clarity here. Maybe Holger Schmieding joins us with Berenberg, their chief economist. Holger, I want to go to the politics of the moment. I'm sure be unspoken within the press conference. The hawks, the traditionalists at the ECB, which you have beautifully enunciated over your career. How does Bundesbank respond to this semantic jumping through hoops on dovish practices?
Well, the Bundesbank won't quite like it, but what we probably will learn is that today's statement, today's press conference, is only the prelude to the really big decision. The hawks will now probably try to sum up all the strength to influence the December decision. In December, the ECB will probably not be able to duck the issue, namely, when does the emergency end? When does the PEP emergency program has to end? And as a result, expect the hawks to make quite a few noises in coming weeks to prepare for probably a decision in December that will be hotly contested and may give us a better clue about the genuine tapering that will come at some time next year, whether it starts in April or whether it will take longer.
Olga, this is really difficult for people to follow because there's two programs running in parallel. There's PEP on the one side, there's APP on the other. If they end PEP, because as you say, the clue is in the name, emergency, if that ends, what does it mean for the asset purchase program?
That's another big open question. It probably will mean that the normal asset purchase program is beefed up, and I expect it to be made moderately more flexible to react to market conditions, but to not be anywhere as flexible as the current emergency program. So the compromise will likely be, in my view, and it will be hotly contested, that in December the ECB tells us, yes, the PEP, the emergency program, will be phased out from April onwards. At the same time, the standard program that is open-ended will be raised a bit and made more flexible. So, but that's the debate for the next few weeks with the December decision, rather than anything we will probably learn the details about today. Today is probably just the day when we may learn, yes, there is a serious debate going on, and they have agreed to disagree until December.
On a broader level, Holger, the message from the ECB is similar to the one from the Fed. They will use all tools to get the average inflation rate at target. Even if it exceeds temporarily, they're not going to be phased by that. And frankly, they talked about potentially even adding accommodation should that become necessary. This was incredibly dovish. And you do see bonds in the Euro region actually rallying to a significant degree. Is this basically the market saying that they don't believe that the ECB could ever reach that goal that they're setting out in inflation?
Well, the ECB statement today seems to be almost the same as the previous statements, so that is no change, except for this moderation of the pace of asset purchases, which, however, was flagged in advance so much so that the bond markets, you could say, reacted already to that. Again, the outcome of what we will hear in December at the real decision is open, and the hawks will probably in coming months get even higher inflation rates, transitory, but higher inflation rates to make their point. So that will be very interesting.
Question in the presser for President Lagarde, Holger. What is it?
Sorry, say it again, please.
Have you got a question for President Lagarde in the presser? the news conference in about 37 minutes' time.
My key question would, of course, be how flexible can the standard asset purchase program be, the open-ended program, once the ECB finally declares the pandemic emergency over? It's not just the size of asset purchases, also this flexibility to react to market conditions, which is, if need be, help Italy and the like. It is also that element which really, among the hawks, is hotly contested, and that's putting it mildly.
We did not discuss that at today's meeting, Mr. Smeeding. We are committed to financial conditions remaining easy through the projected horizon. Holger Smeeding, thank you. You know what's going to happen at 8:30 Eastern. Berenberg Chief Economist, thank you
100%.
very much.
This is tapering.
So a rate change, no rate change, as expected, a guidance change, a pace of purchase change at the ECB. Tom, as Holger points out, the bigger questions are going to be asked at the end of the year. When PEP ends, how much flexibility runs over from that emergency purchase program to the open-ended asset purchase program? That will define how easy, so to speak,
John,
this ECB is going to be.
You're way expert on this versus me or Lisa. How is dissent colored at the ECB? If Belgium and Bundesbank, Germany Bundesbank, can dissent, is that a visible dissent like here, or even more so?
This is how it often plays out, Tom. Unfortunately, this is how it often plays out. You're going to get the decision. We've just had it. We'll get the news conference. Maybe during the news conference or immediately afterwards, Tom, you'll get a story that comes out according to sources close to the decision. They'll make themselves heard pretty quickly. They'll be looking to set the tone going into year end. It's not about a win today, reducing purchases, this pace of purchases. That is not what this is about. This is about shaping the program beyond next year and limiting the flexibility, for the hawks at least, not my view, but for the hawks, limiting the flexibility in the emergency program from spilling over to the asset purchase program. So there's something for everyone here going into next year. And Tom, a lot of questions still unanswered.
I go back to the chart Lisa showed earlier, the balance sheet buildup of ECB, Fed, and all of them. It's all the same. There's no textbook that covers what we're talking about.
It's staying that way for a long time. Let's be clear about that, Tom. It really is.
No textbook.
Tom Keene, Lisa Brammitz, Jonathan Ferro, your equity market down about 1/10%. Yields in Italy.
Huge move.
Yields in Italy down about 4 basis points. The euro stronger by 0.2. What a morning. Welcome back, Tom. From New York, this is Bloomberg.
会場に行って観戦するということも難しいお子さんがいるんです。このように冷房の効いた香港の体育館の中で、それこそ大会の最前列で観戦ができる、体験ができる、こういうことをとてもありがたいことだなというふうに思っていますし、この技術に感動しています。予想以上に子どもたちの反応が良かったというのはですね、とても校長として嬉しく感じております。この子どもたち、どれだけオリンピックの心待ちにしていたのかっていったことがよくわかるような今日の表情です。
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We are seeing transitory surge in inflation.
This is not a market of everything is going to go up, everything is going to win.
It's all about the fundamentals. Earnings expectations are still rising.
When we look at consumer finances in general, there's still potential for the consumer to spend over time.
Everybody's talking about supply chain risk and inflation. We're actually starting to see that come in the numbers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An interesting day. Lagarde in this hour with her comments on taper, non-taper, mini taper, maxi taper, and the rest of it. We'll have too much coverage of that as we get to 8:30. Selling the hell out of it, John. You know, what matters to me, John Farrow, as we heard in the opening there, and the guests are the quality of what we do at Bloomberg Surveillance. Ben Laidler outlines the fundamentals of the equity market, and Savita Subramanian goes the other way, and the distinction is she's focused on the bond market.
Bank of America looking for 42.50 year end. It's an upgrade from 3,800, but it's nowhere near some of the price targets elsewhere. Yeah. And into next year, we've heard calls of 5K, Tom, 4,900, 48.47. Savita's looking for 4,600 on the S&P 500. And that divide exists, Tom, beyond the market, in economics as well. That's been a theme for this program so far this morning. Take a look at the labor market. I can give you some data that shows you this labor market is tight. Right. I can give you some data that shows this labor market is loose. That debate's going nowhere anytime soon.
The distinction, John, on ECB is simple. U.S., maximum stimulus. ECB, far, far, far less stimulus.
Look, let me put it this way. Capital Economics, their line, it came out a couple of minutes ago, and I think it sums things up perfectly. The ECB slows purchases, but will keep policy ultra loose. The real test for that, it's in the Italian bond market. The Italian bond market is rallying. Yields are lower this morning.
What does that mean for the Bundesbank?
For the Bundesbank, right now, let's see what you've got. Jens Weidmann going into year end. Can you make sure that the flexibility in this pandemic emergency purchase program does not get folded over to the asset purchase program next year? Let's see what the forecast looked like for one, Tom.
The smartest thing I've heard in the last, I was off a sabbatical a long time, folks. I'm just getting back into it. Lisa, you talked about the pendulum of the S word. And so there it is. Stagflation is really what we're all talking about.
And just to be clear, before John starts rolling his eyes at me, which I'm sure he will, it's hard to talk about stagflation when you're looking at a GDP growth rate of 5% in the United States, right? This is hard to call this some sort of dismal backdrop economically. However, this dynamic of peak margins, as Savita Subramanian was talking about, Seth Carpenter talking about peak inflation, at least in with respect to supply chain disruptions in the goods and the commodities. How much does that give way to the fundamental weakness that has been overlaid by the pandemic? And I think that a lot of people are trying to figure that out right now.
I'm going to just say simply the VIX comes in, John, from 19 gloom into 18.27. John, red and green on the screen. The Dow red, the NASDAQ green.
The S&P 500 just a little bit red. Let's whip through it together,
Let's
Tom.
do it together.
We're down 2 on the S&P. It's beautiful, isn't it? This partnership just means so much to me. I missed you too. We're down 0.05%
I think I just
on the
threw up
S&P.
a little in my mouth.
Yields off the lows, 133.26. The euro near the highs of the session. Euro dollar 118.41. Slightly stronger euro in the mix, Tom. That news conference starts in about 26 minutes. We've got jobless claims too, TK. We'll get to claims before that.
You know, like a lot of our people watching across this nation and frankly worldwide, that's what Wednesday's about. You take your kids back to school, you start drinking early. I mean, John,
Is that what your long weekend was, Tom? A long weekend. I did wonder where the energy levels were first thing this morning after your 3-4 day sabbatical.
Always with a good energy level. David Riley saves us right now with Blue Bay Asset Management. David, I make the economic distinction of massive stimulus in the United States. How constrained is Christine Lagarde with a lack of U.S.-like stimulus in Europe?
I think it is a constraint, and I think the decision today to reduce the volume of asset purchases, however moderate that may be, and maybe we'll get some insight into that from Lagarde in the press conference, is a taper to me. I mean, you're reducing the volume of asset purchases. We know that there's an end point as well for the PEP. So it sounds to me that it is a taper. I think it's kind of been well flagged within the market, which is why we're not really getting any kind of meaningful reaction. But I think it's quite a contrast, as you've highlighted, Tom, with the US, where there's still debate about additional fiscal stimulus on top of the huge stimulus that we had this year and last, but also where, you know, inflation really is running above target and has actually been averaging over 2%, arguably over the last 3 years on average. So, you know, the US isn't facing a kind of disinflationary, deflationary trap, and yet I think that Europe is still facing that potential, and yet we're having an ECB that de facto is tapering before the Fed.
David, the words do matter, though. Tapering at the ECB is not the same as tapering at the Federal Reserve, because we could get a boost to the asset purchase program next year. So ultimately, what does it all mean for markets? Personally, for whatever my view's worth, if the Federal Reserve is doing that, it's removing accommodation. If the ECB is doing it, I just don't know the answer to that until next year.
No, I think that's fair, which is what happens when the PEP comes to an end to the sort of broader QE asset purchase program, and the presumption in the market is that that will be increased, but we don't really know by how much it would be increased. We also don't know, as you've been speaking to with your guests as well, in terms of the sort of flexibility. I mean, there's a lot of constraints around, sort of self-imposed constraints around QE that the ECB has, which the Fed doesn't limit itself by. So I agree with you. It's just, look, you know, we had in July an ECB conclude a strategic review and said it's, 2% symmetric target. We're going to do whatever it sort of takes. And at the following meeting, it's marginal, right? Maybe we're debating sort of angels on a pinhead. But at the margin, it's a marginal reduction in the rate of easing, if you want to describe it in that way.
So, David, considering the fact that a number of guests have come on this show and said that they like Europe over the U.S. when it comes to riskier assets, in particular stocks, do you disagree with that assessment? Because you do think that, in effect, the ECB is taking more of a tightening or less easy approach than the Fed at this point?
Well, I think it varies according to the assets. So, for example, in European corporate credit, it's been incredibly low volatility, really very much not much happening, and actually most of the corporate bond purchases have actually been done under the QE program rather than a PEP. That's likely to continue, so that's fine. I think that actually is a reasonable place for investors to be. I think with respect to more sort of growth sensitive assets, I just think there's more willingness and policy levers in the US, both monetary and fiscal, in order to have a breakout in terms of growth, have a breakout from the sort of secular stagnation fears than there is in Europe. So I think over medium term, I would expect US growth sensitive assets to outperform. I think equities over the medium term, US equities will continue to outperform.
David, with that optimistic tone on the American stock market, how do you, as a bond guy, respond to equity strategists basing their equity call to a heavy weighting on central bank and bond dynamics?
Yeah, I think what we've seen, though, I think within the, sort of equity market is what's kind of going on under the hood. And I think for equity investors, obviously the bond market matters a lot, particularly for this kind of, relative performance of growth, long duration growth stocks, US tech versus value. I do think that real rates are too low in the US. I think part of that is due to the distortions created by the Fed in its purchases of tips, and that once the Fed does start to taper, we will see real rates move higher, and that is going to be, in the short term at least, I think, a headwind for growth stocks, and therefore a headwind for some of the headline the S&P and some of the headline equity indices. But you asked over the medium term, where would I kind of place my bets as to who's going to sustain the recovery and avoid being sucked back into a kind of secular stagnation environment? Then I would say the US over Europe, and therefore that would make me more bullish over the medium term for US growth assets.
David Riley, interesting stuff, as always, of Blue Bay Asset Management, the chief investment strategist. Let's round things up for you. Equity futures in the United States, just off the lows on the S&P 500. We're down 3, we're negative 0.06%. Treasury yields, they erased the rally of the morning as well. We're now higher by almost half a basis point. Marginal move, but we were lower by a couple of basis points on 10s, now 134.10. In the bond market, euro dollar, euro stronger by 0.2 at 118.38. And it's the Italian bond market that gets my attention going into this ECB news conference, Tom, in about 20 minutes' time. Yields in by 3-4 basis points to about 72 basis points on an Italian 10-year as the ECB reduces the pace of purchases, but no doubt President Lagarde will be very keen to emphasize that they remain very, very loose when it comes to accommodation for financial conditions.
John, where's the bid on Italian paper? Is it like a Draghi trust? Is he runs the country? Is it something else?
For the confidence in BTPs?
Yeah.
I think politics is part of it. If you think of the last gap wider we had, Tom, back in 2018, that was down to political uncertainty outside of the pandemic. A lot of that was about political uncertainty and the future. I think people look to Draghi as a bastion of stability, maybe. But, Tom, for me, this comes down to the ECB. For the ECB, from the market's perspective, the Italian bond market is the North Star, and financial conditions have got to remain loose for the country in Italy and for the periphery too.
I'll start watching it. I've never...
I think you've been watching it for the last 10 years, and maybe longer. Yields unchanged on 10s, 133.93.
Lake Como Water Company
Equities
bonds.
Unchanged. What bonds have you got?
Lake Como Water Supply.
Oh,
they did the pipelines up to George Clooney's place.
You're long Lake Como?
Yeah.
Nice. Lake Como or Lake Como?
Perry Como. Yeah,
okay.
Perry
just wanted you to
Perry had a place there,
and highlight and just clarify for us, Tom. Thank you. News conference 20 minutes away. Less of us, more of Lagarde coming up on Bloomberg Radio. That's a promo these days, Tom, and on Bloomberg TV too.
You just sold it like crazy. I tell you,
we won't be on.
More of her and less of us coming up in 20 minutes from New York. This is Bloomberg.
How about those Red Sox?
With the First Word News, I'm Ritika Gupta. The White House reportedly will unveil a plan today to cut prescription drug prices, according to the Dow Jones. The plan would push to empower the federal government to negotiate for lower drug prices in Medicare and then pass those savings onto the private sector. The pharmaceutical industry says that would reduce the funding for the development of new drugs. Traders are rushing to dump Chinese tech stocks. That's after Beijing took aim at gaming companies for focusing solely on profit. Executives from a number of companies were summoned to a meeting where they were reminded of their obligations to society. One of those companies was Tencent Holdings, which fell almost 9% today. Also in China, inflation at the factory level was hit a 13-year high. Producer prices rose 9.5% in August from a year earlier. That was driven mainly by high prices for those commodities. Output prices in the coal industry grew the fastest, up 57% from a year ago. Goldman Sachs is dropping social distancing rules in its London office and will return to full occupancy next week. According to an internal memo, Goldman's already is seeing about half of its London staff in the office each day. The firm is also ending free meals in the office. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
After 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I would love to see us sooner rather than later start taking our foot off the accelerator, because I think the longer we make these purchases for longer than necessary, I think it may actually make it so that we have less flexibility down the road
Robert Kaplan there, the Federal Reserve Bank of Dallas president from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bramvitz, I'm Jonathan Ferro. Here's the price action in the equity market. We're 12 minutes away from initial jobless claims data in America and a news conference with President Lagarde of the ECB in Frankfurt, Germany. Yields on a 10-year unchanged at 133.42. Euros stronger. Euro dollar 118.37 in the equity market, erasing some of the losses of this morning. Still negative, though, by 3 points. We're down almost 1/10%. If you want to read on what's happening in Italy, I'll give you one just very quickly. Please. The Italian bond market is bid. Yields are lower by 4 or 5 basis points to about 70 basis points on an Italian 10-year, Tom. So a rally on the periphery this morning.
Very good. This is a joy. We had a lot of different opinions on the market today, but I'm going to be clear. If you're an optimist or you're wondering what the optimist theme is, on a global basis, there's no one that delivers that tone right now. That narrative, like Jay Pulaski with TGW Investment Management after a sterling career at Morgan Stanley. Jay, I am thrilled to have you here. I have been a glasses half full guy, and I want to cut to your analysis where you talk about stellar earnings. Is that discrete to America, or is that global stellar earnings?
It's global, Tom, and I think this is one of the key points because we're probably in the early stages of the handoff from liquidity-driven markets to earnings-driven markets. So it's important that earnings continue to deliver, and they have delivered not only in the U.S., but also in Europe and Japan. A little bit less so in emerging markets, but I think that's going to change as we move forward. I'm looking for a synchronized global expansion as we exit 2021 and focus on 2022, which I think is where we're starting to focus. And that is going to support continued earnings growth, which is going to support continued higher equity prices, particularly outside the U.S. And right now, at the moment, very bullish on Asia.
Let's not bury the lead then. Asia. Why Asia, Jay?
Well, I think we're about to see the true reopening, John. I've talked about a synchronized global expansion for the last couple of quarters. We haven't really seen it because we had, when Asia was open in the early part of the year, Europe was closed. Now Europe and the U.S. are open. Asia has been closed, right? We had PMIs in China and ASEAN at around 45. That's a sign of a lockdown. Goldman has a good lockdown index, which is starting to show Asia lockdown easing. I think that's going to impact the cyclical side of things. Is going to impact the commodity side of things. EM has been a big underperformer. Every day it's China edicts knocking down China tech shares. I think there's an opportunity there. We're overweight Japan, and we're adding to Asia ex-Japan as we speak.
Asia ex-Japan. Do you do Asia ex-China as well, Jay? And how easy is that actually to do in practice?
Yeah, it's a great question, John, because as you know, I focus primarily in the ETF space, and it's difficult. I'd really like to buy ASEAN, for example, right? The Southeast Asian nations, because I think that's where all the dynamism is in terms of consumption and production. As the supply chains, as the lockdown eases, supply chains reopen, that's a segment where you're going to have a lot of action. Very hard to buy. There is an ETF. It's completely illiquid. So you got to do individual country funds, which then becomes a problem. You have 5 funds for Asia. You know, how many funds you're going to have and how many ETF positions are you going to have? So it is actually quite a bit tricky. But you play that also through the commodity side, and there the ETF space is pretty good. So I think we're going to be able to find our exposure.
So when you talk about supply chain disruptions, I do wonder how this factors into the cyclical tilt that you are giving your portfolio. This idea, they are ongoing. This is going to be a problem, and frankly, it's crimping growth and profitability. What is your call? When are these supply chain kinks worked through?
Well, yeah, at least I think that's great. I don't have the crystal ball. I wish I did. So I don't know when actually it's going to all be done and perfect. But I think we're going to get better. Look, Asia is the production factory for the world. It's also where 2/3 of the annual GDP growth comes from. And so the fact that Asia starts to reopen, starts to grow, China airline departures, for example, were up 30% over the last month after their short lockdown. So I think as we move forward, as Asia reopens, that's the start of the production reopening. That's the start of the kinks and the supply chains easing. And look, companies are having record margins, so we can talk about supply chain disruptions all we want. But the reality is, back to Tom's original point, margins, corporate margins, all-time highs. Earnings growth, 30%. Bank of America 1-year forward earnings growth estimate globally, globally, is at 30% year over year. equities are not going to go down when you have 30% earnings growth year over year. Flat statement.
Well, and what Savita Subramanian is saying is that perhaps we've got peak margins. But just going to your China call, and you can argue against that another time, but this question of ex-China, when you cite China as the center of a lot of these infrastructure types of plays that could be potentially positive, are you staying away from China purposefully because of some of the regulatory uncertainty?
No. No, as I said, I am holding our China positions. We have China healthcare positions. We have China broad tech positions, and we're holding them. We haven't sold them. We've been holding them throughout this entire couple of months. It's been a little bit painful, but look, the growth in China is going to continue. And I'm more worried about an Evergrande, the big property developer, an Evergrande implosion than I am about continued China edicts.
Wait,
I think China's doing a lot.
Do you actually see any contagion or any signs of a contagion from the Evergrande situation?
Not yet, but I think it's something that we should all be worried about. It's huge, it's indebted, and the bonds are basically trading as if it's going to go bankrupt, particularly the offshore bonds.
Come on, Jay, they're just going to write it down. I mean, the government's going to step in as lender of last resort and take the thing down to zero and we move on, right?
Yeah, and they're going to stiff the offshore bond holders, and that's probably already in the price. For the most part, I think you're right, Tom. But the question of China and the question of these edicts that keep coming out and the impact on the stocks, I think for the most part it's already bottomed. I made the case that Delta was discounted back in July. I think China government edict were discounted 2 or 3 weeks ago. We haven't come back to those price levels, and I don't think we're going to. You can't keep beating the same drum and have the same impact. Markets are too smart for that. We've already moved on, and I think the focus is the PBOC going to ease down the road here? I think that's quite likely, and that's going to provide support. And look, China, I think my old colleague Stephen Jen, we had a great call yesterday. He runs his own hedge fund in Europe, Morgan Stanley FX strategist. He said that this is all a kind of a shakedown. Right? The Chinese government is long state-owned enterprises, which are not growing. They don't have a play in the private, fast-growing tech sector in China. They want that play. They're going to drive the price down, and then they're going to start to take positions through other entities. You saw the first foray here with Didi in the last couple of days, talking about state-owned enterprise taking a stake in Didi. So I think there's a lot going on here. China understands it needs to raise capital. They have tremendous needs to raise capital, and so they're not going to kill the equity market. This is a social issue, and we're probably 2/3 of the way through it.
Hey, Jay, you run down the clock. We didn't even talk about Europe, but there you go. That's your fault, not mine. Jay Pawlowski of TPW Investment Management, founder and principal. A headline crossed on a Bloomberg: China releasing national crude oil reserves for the first time. WTI, now unchanged on the session, was positive. From New York, this is Bloomberg.
The power of Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market?
There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Live from New York City for our audience worldwide, heard on radio, seen on TV. This is Bloomberg Surveillance. A couple of things to get through now. Jobless claims coming out in just a couple of seconds' time. After we break that with Michael McKee, we'll then turn to an ECB news conference in Frankfurt, Germany, with President Lagarde. Equity futures this morning down about 6 on the S&P, negative a little more than 0.1% on the S&P 500. Yields in almost a basis point to 132.92. There are the numbers. There's the data. Here's Mike McKee.
Well, John, we've got some really good news on the jobless claims front, which is a little bit of a surprise. 310,000 jobless claims. That's down from a revised number of, let me see here, 354,000. So at this point, it is a big drop, and it is the lowest since March 14th of 2020, when it was 256,000. So we're getting slowly back down to the pre-pandemic level. And at 310,000, one would expect that we could get down to the 200,000s, which at one point we thought was unbelievable, in the next couple of weeks or so, depending on the seasonal adjustments. I'm just looking here. I don't see any indication that states had to estimate claims. And the reason I said claims might be a surprise was because of Hurricane Ida. And so maybe next week we'll see some effects from that, because the people who couldn't get to work would be filing.
Mike, thank you. The right kind, a downside surprise on initial jobless claims at 310 against an estimate of 335. Very little price action off the back of this. Yields coming in by almost a basis point to 132.92. Tom Keene, I can see they've entered the building, entered the room in Frankfurt, Germany for the ECB news conference. President Lagarde standing by for photos alongside the ECB Vice President, Luis de Guindos. Do you think this is going to be a testy one? We'll get those forecasts in just a moment too.
I mean, it's dazzling. There's 3 of them there. They're set as like fancy versus what Chairman Paul does. I love the podia. I think they're, really.
Do you like that?
Really appropriate.
I thought you might like the design of the room, Tom.
It's blue. It's Frankfurt blue.
You think they copied us?
Could you imagine, John? Could you imagine if Axel Weber or Otmar Issing was up there right now,
standing at a podium?
Yeah.
Can I imagine him standing, or can I imagine him talking the same way President Lagarde will be talking in a moment?
It'd be a different tone than what we're going to get from Christine Lagarde.
Well, let's get that tone right now with the ECB President Christine Lagarde about to deliver that news conference after leaving rates unchanged but adjusting the pace of the pandemic emergency purchase program. That news conference is just about to begin with euro-dollar at 118.30 rather, positive a little more than 0.1%. President Lagarde just receiving her introduction. Let's take a listen.
And good afternoon. The Vice President and I welcome you to our press conference. The rebound phase in the recovery of the euro area economy is increasingly advanced. Output is expected to exceed its pre-pandemic level by the end of this year. With more than 70% of European adults fully vaccinated, the economy has largely reopened, allowing consumers to spend more and companies to increase production. While rising immunity to the coronavirus means that the impact of the pandemic is now less severe, the global spread of the Delta variant could yet delay the full reopening of the economy. The current increase in inflation is expected to be largely temporary, and underlying price pressures are building up only slowly. The inflation outlook in our new staff projections has been revised slightly upwards, but in the medium term, inflation is foreseen to remain well below our 2% target. Financing conditions for firms, households, and the public sector have remained favorable since our previous quarterly assessment in June. Favorable financing conditions are essential for the economy to continue its recovery and to offset the negative impact of the pandemic on inflation. Based on a joint assessment of financing conditions and the inflation outlook, the Governing Council judges that favorable financing conditions can be maintained with a moderately lower pace of net asset purchases under the Pandemic Emergency Purchase Programme than in the previous 2 quarters. We also confirmed our other measures, namely the level of the key ECB interest rates, our forward guidance on their likely future evolution, our purchases under the Asset Purchase Programme, our reinvestment policies, and our longer-term refinancing operations as detailed in the press release published at 1:45 today. We stand ready to adjust all of our instruments as appropriate to ensure that inflation stabilizes at our 2% target over the medium term. I will now outline in more detail how we see the economy and inflation developing, and then talk about our assessment of financial and monetary conditions. Let's turn to the economic activity. The economy rebounded by 2.2% in the second quarter of the year, which was more than expected. It is on track for strong growth in the third quarter. The recovery builds on the success of the vaccination campaigns in Europe, which have allowed a significant reopening of the economy. With the lifting of restrictions, the service sector is benefiting from people returning to shops and restaurants and from the rebound in travel and tourism. Manufacturing is performing strongly, even though production continues to be held back by shortages of materials and equipment. The spread of the Delta variant has so far not required lockdown measures to be reimposed, but it could slow the recovery in global trade and the full reopening of the economy. Consumer spending is increasing, although consumers remain somewhat cautious in the light of the pandemic developments. The labor market is also improving rapidly, which holds out the prospect of higher incomes and greater spending. Unemployment is declining, and the number of people in job retention schemes has fallen by about 28 million from the peak last year. The recovery in domestic and global demand is further boosting optimism among firms, which is supporting business investment. At the same time, there remains some way to go before the damage to the economy caused by the pandemic is overcome. There are still more than 2 million fewer people employed than before the pandemic, especially among the younger and lower skilled. The number of workers in job retention schemes also remains substantial. To support the recovery, ambitious, targeted, and coordinated fiscal policy should continue to complement monetary policy. In particular, the Next Generation EU programme will help ensure a stronger and uniform recovery across euro area countries. It will also accelerate the green and digital transition, support structural reforms, and lift long-term growth. We expect the economy to rebound firmly over the medium term. Our new staff projections foresee annual real GDP growth at 5% in 21, 4.6% in 22, and 2.1% in 23. Compared with our June staff projections, the outlook has improved for 2021 and is broadly unchanged for 22 and 23. Inflation increased to 3% in August. We expect inflation to rise further this autumn, but to decline next year. This temporary upswing in inflation mainly reflects strong increase in oil prices since around the middle of last year, the reversal of the temporary VAT reduction in Germany, delayed summer sales in 2020, and cost pressures that stem from temporary shortages of materials and equipment. In the course of 2022, these factors should ease or will fall out of the year-on-year inflation calculation. Underlying inflation pressures have edged up. As the economy recovers further and supported by our monetary policy measures, we expect underlying inflation to rise over the medium term. This increase is expected to be only gradual, since it will take time for the economy to return to operating at full capacity, and therefore wages are expected to grow only moderately. Measures of longer-term inflation expectations have continued to increase, but these remain some distance from our 2% target. The new staff projections foresee annual inflation at 2.2% in 21, 1.7% in 22, and 1.5% in 23, being revised up compared with the previous projections in June. Inflation, excluding food and energy price inflation, is projected to average 1.3 in 21, 1.4 in 22, and 1.5 in 23, also being revised up from the June projections. Let's turn to the risk assessment. We see the risks to the economic outlook as broadly balanced. Economic activity could outperform, and expectations if consumers become more confident and save less than currently expected. A faster improvement in the pandemic situation could also lead to a stronger expansion than currently envisaged. If supply bottlenecks last longer and feed through into higher than anticipated wage rises, price pressures could be more persistent. At the same time, the economic outlook could deteriorate with the further reopening of the economy, or if supply shortages turn out to be more persistent than currently expected and hold back production. So let us look at the financial and monetary conditions now. The recovery of growth and inflation still depends on favorable financing conditions for all sectors of the economy. Market interest rates have eased over the summer, but reversed recently. Overall, financing conditions for the economy remain favorable. Bank lending rates for firms and households are at historically low levels. Lending to households is holding up, especially for house purchases. The somewhat slower growth of lending to firms is mainly due to the fact that firms are still well-funded because they borrowed heavily in the first wave of the pandemic. They have high cash holdings and are increasingly retaining earnings, which reduces the need for external funding. For larger firms, issuing bonds is an attractive alternative to bank loans. Solid bank balance sheets continue to ensure that sufficient credit is available. However, many firms and households have taken on more debt during the pandemic. A deterioration of the economic outlook could threaten their financial health. This, in turn, would worsen the quality of banks' balance sheets. Policy support remains essential to prevent balance sheet strains and tightening financing conditions from reinforcing each other. In conclusion, the euro area economy is clearly rebounding. However, the speed of the recovery continues to depend on the course of the pandemic and progress with vaccinations. The current rise in inflation is expected to be largely temporary, and underlying price pressures will build up only gradually. The slight improvement in the medium-term inflation outlook and the current level of financing conditions allow favorable financing conditions to be maintained with a moderately lower pace of net asset purchases under the PEP. Our policy measures, including our revised forward guidance on the key ECB interest rates, are key to helping the economy shift to a sustained recovery and ultimately to bringing inflation to our 2% target. We now stand ready to take your questions. Thank you.
Thank you. And today the first question goes to Tom Fairless of the Wall Street Journal. Tom, please.
Hi, thanks very much for taking my question. I had two questions. The first was on the pace, on the discussion around reducing asset purchases. And some of your council members have suggested that they would like to see the PEP program coming to an end soon. Would you characterize this, or did you characterize this internally as a taper, or is it a turning point, or how would you characterize the move? And the second question was around why you feel confident enough to do this. Your 2023 outlook for inflation is 1.5%, which is some way below your medium-term target. There also seems to be a lot of uncertainty in the global economy around Delta, around slowdown in China. So why did you think this was reducing your stimulus was the correct move? Thank you.
Well, thank you so much for your questions. I would preface my response to your first question by a quote, actually, in a way, which is, "The lady isn't tapering." Because what we are doing is recalibrating PEP, which I remind you is the Pandemic Emergency Purchase Program, and we are recalibrating just as we did back in December and back in March. We're doing that on the basis of the framework, which is a joint assessment. So we look at the financing conditions, and we concluded that they remain favorable. And we do that on the basis on the inflation outlook. And as you rightly pointed out, our inflation outlook has been upgraded, and it has been the case for 21 significantly, 22 quite significantly, and to a lesser extent 23. But across the board, you have an improvement on the inflation numbers for the whole horizon that we look at. We also look at other indicators, and on those accounts as well, there has been a significant improvement of the inflation numbers, both for 22 and 23. So on the basis of that joint assessment, and because we know that we need to keep favorable financing conditions, this is the commitment that we have, and this is what we agreed in December. That hasn't varied. We believe that we can maintain those favorable financing conditions with a moderately lower pace of purchase. And of course, the choice of words is relevant. It is moderately lower than what we have done in Q2 and Q3. Are we confident enough? Well, the September meeting is conducted in the light of our projections. And what we are seeing is clearly an improvement on many fronts. The output numbers are much higher. The inflation number have been upgraded, as I just indicated. The employment numbers have also been improved, and the unemployment situation is serious, of course, but more benign than was anticipated. So on the basis of all that and the success of the vaccination campaign, which we have all along said was critically important to determine the economic recovery, we believe that the euro area economy is rebounding. And that gives us the confidence to take the measure that we have taken, which, as I said, is a recalibration of our pandemic emergency purchase program for the next 3 months.
Thank you. The next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, over to you, please.
Hello, and thank you for the opportunity, and nice to see you on WebEx.
Reciprocating.
President Lagarde, I have 2 questions. My first question is on financing conditions. For how long will the ECB preserve favorable financing conditions to support the recovery also after the COVID crisis? In a sense, will favorable financing conditions end with the end of the pandemic emergency purchase program? And my second question is on PEP. As the coronavirus crisis enters a new phase, as you have described, with the new Delta variant, but also better economic outlook and a good pace of vaccinations, can you tell us a bit more how the Governing Council intends to judge and assess the end of the COVID crisis phase, given that PEP will end when the COVID crisis phase is over? Thank you.
Well, thank you. Thank you very much. And it's very nice to see you as well. This is a significant improvement from previous press conferences. So we're probably heading in the right direction here. Next step will be to actually see each other with appropriate distance between us. On the commitment for favorable financing conditions, I'll remind you that that was decided at our Governing Council meeting in December under the auspices of PEP. So PEP is this emergency program, very specifically designed for the circumstances that we have been facing, that we still face today, but that are currently clearly improving. And this commitment to the favorable financing conditions is one of the 2 parts of the joint assessment that we conduct to determine our base of purchase. So we have a framework that is very clearly designed and that operates in relation to PEP. And the day when PEP is over, which presumably by then will indicate that financing conditions are favorable and that the economy will have recovered in such a way that the downward impact of the pandemic on our inflation outlook has been resorbed, at that point in time, then job is not finished, because we are still targeting our 2%, which is now clear and straightforward as a result of our strategy review. Symmetric, 2% medium term, with a special focus resulting from the lower bound. So that will continue. And the driver of our work going forward after PEP will indeed be the mandate that we have to maintain price stability as measured by our target of 2% inflation. On your second question, which has to do with PEP in general, what we have done today with the Governing Council members unanimously is to calibrate our pace of purchase in order to continue to deliver on our goal of favorable financing conditions. We have not discussed what comes next. And this is something for which we will prepare in the months to come. And I think there will be more interesting matters that will be debated in December, and for which clearly you will be informed in due course.
Thank you. Next question goes to Alexander Weber of Bloomberg News. Alexander, please. Alexander, can you hear us? Does not.
Yeah.
Go ahead, please.
Here we go. Thank you. Thanks for taking my questions. President Lagarde, some of your colleagues, including Jens Weidmann, have recently emphasized the upside risks to the inflation outlook, and that the higher inflation could prove more permanent than currently expected. Could you tell us whether this view is widely shared within the Governing Council and what the discussion was like at this week's meeting? Then a question on your monetary stimulus. How much notice will you give markets before the PEP comes to an end?
Sorry, I completely missed your second one. How much what?
How much advance notice will you give markets before the PEP comes to an end?
Okay. Well, thank you for the first question, because I'm going to take advantage of that one to say a few words about inflation and how we conducted our discussion on inflation. Because it is a case that in many countries in the euro area, people are seeing prices increase, and they can feel it. So we have to really go under the skin of inflation before we actually assess whether it is temporary, whether it is going to last, and that leads us to the conclusion of our inflation outlook, which, as you know, is 1.5 at the end of the projection horizon. So what do we have at the moment? We have essentially three factors that are driving prices up. The first set of factors have to do with the reopening of the economy. I mean, this is the entire dynamic. It went down massively, and prices, by the way, at the time also went down. The economy reopened, and from a supply point of view, from a demand point of view, of course, there is pressure on prices. You can see that in what we call the base effects. A lot has to do with energy prices, which constitutes a large component of these base effects, inflation factor on inflation. You can see that on the German VAT impact, which obviously will continue to play out until the end of the year. You see that in the carbon tax that was decided also in Germany. So those are the base effects, reopening of the economy related factors. As part of those reopening of the economy factors, I would distinguish the supply bottlenecks effect. And this is something that the corporates and the companies are telling us, are telling you. There are bottlenecks effects, and not just in the semiconductor business, but in all sorts of sectors that are more or less affected depending on how much they rely on those either raw materials or equipment that they get their supply from. And this is impacting the durable and the non-durable goods. Now, how strong will that effect be? How long will it last is something that obviously remains to be seen. And we have put that particular item, if you remember the monetary policy statement that I read for you, we have put that in the inflation analysis, where we say that if those supply bottlenecks last longer than expected, then it will have and it will increase prices and will have an upside pressure. But that we're not certain, because typically what we have seen in previous situations of that nature is that, you know, when you have a bottleneck on your supply, well, you try to find alternatives to that supply, and as a result of that, then the supply bottleneck's impact of inflation is reduced and eventually goes away. In the same vein, if it's bottlenecks inflation that applies without too much on the demand front, it's not necessarily be conducive to second round effect on wages in particular. So that's the third one. The second one, which is a subset of the sort of reopening of the economic consequences. The third one, which is quite interesting as well, which is, especially when you disaggregate it, is the inflation that is related to services. Because we have seen a reopening of the economy on the service front, in the most recent month. And when you analyze where the inflation is in that segment of services, you see that most of it is actually coming from what is subject to social distancing, which obviously has been reactivated most recently. So those are the three key drivers of inflation at the moment. But as you can see, many of them are of a temporary nature and will last for a period of time and will then either fall out of the period of reference or will fade out over the course of time. One component that we are addressing, monitoring and checking very attentively is the second round effect, is the impact that price increases will have on wage negotiations. And that is what could actually fuel a more persistent and durable price increase and inflation going forward. On those wages front, we are not seeing much by way of significant increase. We will be very attentive to the autumn negotiations that are typically taking place in some countries, but at this point in time, we don't expect this wage increases and these wage negotiations to be very strong, and we see probably a gradual and moderate increase as a result of that. So that's what I really wanted to try to explain to you in response to your question about inflation. Now, concerning PEP, that's a discussion that we will address comprehensively at our December meeting as the term of PEP approaches. We need to obviously discuss the terms and conditions of how that term occurs, and you will hear me again on this matter, certainly at our December meeting.
Thank you. Next question is for Annette Weisbach of CNBC. Annette, please, for you.
Thank you very much for taking my question. President Lagarde, I have two. One is, if you read through analyst notes, some are a lot less optimistic about 2022 in terms of economic growth. So what makes you so optimistic for 2022? And then also, the second question is whether you have ever addressed the risk of a stagflationary environment for the Eurozone, given that inflation, as you also say, could be more persistent, or price pressure could be more persistent. Thank you very much.
Well, on your first question about how confident we are, I observed that since the beginning of the year, we have regularly upgraded our forecast. And if anything, we might have been on the too pessimistic side to begin with. And what I look at more so than analyst notes, which I'm attentive to, of course, is the projections that are produced by staff, how they compare with projections that are produced by other international institutions, such as the IMF, the OECD, and other similar institutions. And we believe that, the economy is going to continue to benefit from further unwinding of containment measures during the second half of 21 into 22 as well. We also make the assumption that bottlenecks will be circumvented by the economic operators in the first half of 22. We believe that we will be back to the pre-pandemic 2019 level at the end of this year, which is 2 quarters earlier than we had initially anticipated. And while we still have a lot of slack, both in production and in unemployment, we are also seeing that slack being resolved and reduced more rapidly than we had anticipated. So that gives us good reasons to believe that 22 is going to be another good solid year. We have not upgraded our forecast for 22. We still are at plus 4.6% in our forecast. And our risk assessment, as I mentioned earlier, are broadly balanced. Clearly, if the pandemic is resolved faster because of even further vaccination coverage, the booster is adopted by many, that is going to be an add-on. If more savings are being used by consumers, that will also support consumption, which has been one of the big drivers of the recovery so far. There's still that chunk of saving that was accumulated over the pandemic period, which has not been tapped into, which might be tapped into. So that's for the upside side of our broadly balanced risk assessment. On the downside, clearly we could have a massive fourth wave or other variants coming to the fore for which vaccinations doesn't work. I mean, you have all these possibilities as well. And the supply bottlenecks, which, as I said, we anticipate will be circumvented in the first half of 22, which could last longer and which would have side effect on inflation and putting pressure up and which would weigh on the GDP on the other hand. I think you had a second one which had to do with stagflation. Our primary mandate is price stability. But we are also keen to see an economy that recovers fully. And for that to happen, of course, jobs have to be created. And the furlough schemes that are in place that retains employees in their position but not in actual employment needs to be pursued. And those 2 million people still more than in 2019 that are unemployed have to also return to employment. So if that is the ultimate response of this recovery, then I don't think that we will be heading towards stagflation.
Thank you. Next question goes to Martin Arnold of the Financial Times. Martin, please. Martin.
Hello.
Hello.
Madame Lagarde, can you hear me? Thank you for taking my question. So I have two questions. First one is that your chief economist, Philip Lane, said recently that the amount of assets you purchase after PEP finishes will depend on the amount of debt issued by governments. Do you agree? And my second question is about the link between the ending of asset purchases at the ECB and the first interest rate rise. At the moment, there's a close link in your guidance between asset purchases ending and soon after that, interest rates rising. Do you think that there should be potentially more of a gap or more flexibility on that? Thank you very much.
Well, thank you very much, Martin, for this question. It gives me a chance to actually just repeat yet again, because I think it's an important consequences of our last July meeting, the three criterias that are applicable for our forward guidance on interest rates. And that forward guidance, as you know, has been modified and clarified to a great extent by including three criterias. One is we need to see inflation outlook at target, that is at 2%, well ahead of the end of our horizon, first criteria. Second, we need to see it through also to the end of the projection horizon. And second, we need to have sufficient elements and indication of progress in the underlying inflation criteria as at the time when we make the decision. So you have these three criteria, and you have the other element of our forward guidance that remain intact and which actually play a role in signaling to markets when, what will be the sequence of events from asset purchase to interest rate hiking. I think we are pretty far away from that, and it also gives me a chance to remind all of us that PEP is a very specific program intended for the pandemic. It has an emergency character to it, and when that PEP comes to its term, then clearly we have all the other instruments available. And in terms of purchases, we clearly have the asset purchase program, the APP, which we have on a standing basis ever since October 2019. And that clearly is intended to be continued and will be debated, as I said, at our December meeting. So it's entirely premature to evoke it, and it has not been discussed on the occasion of this meeting. Now, clearly, when we determine our pace of purchase, we are attentive to the entire universe of bonds. We are not paying special attention to the fiscal commitment of one country or the other, or the bond issuance of one country or the other. So we look at the entire universe of bonds that are available, will be available, are being announced, and that's how we determine where our purchase pace is going to be applied. But we do so, as I said, based on two things under our joint assessment. One is the favorable financing conditions. The second is the inflation outlook. Thank you.
Thank you very much. And the next question goes to Andres Stumpf of the Spanish daily Expansión. Andres, please.
Hello, good afternoon. Do you hear me?
Yes.
Okay, I have two questions. You said that the need of a PEP recalibration was unanimous. I would like to know if it was also unanimous, the pace decided. And the second question is, after the operation later this month, that would be the only chance, the final chance, there will be only a chance for the banks to borrow money at the long-term tenors and the TLTRO next December. I was wondering if the ECB has taken any decision on this regard, and if there will be any long-term funding operations for the banks, any more operations, I mean.
On your question about the decision that we made today, as I said, it was a unanimous decision in all respects. So the pace of calibration was agreed. The moderately lower determination was agreed unanimously. It was all unanimous. So I'm sorry for those who like to oppose the doves and the hawks. Sorry. For this time, there's not much that you can actually draw from dissenting votes, because we all agreed. TLTROs, you're right. There will be one more operation in December. And we will clearly have to discuss what comes next on the basis of the situation at the time. And I think that will be part of the overall re-examination that we conduct at the time of our December meeting. This will be, as usual, data dependent. And what we have seen based on the bank lending survey, based on the discussions that we've had with representatives of the banking sector, is that TLTROs, certainly the earlier ones, more so than the most recent one, have been critically important to help them and encourage them to provide lending to the economy, which they have consistently done over the course of the last 2 years. Thank you.
Thank you. And the next question goes to Ilias Iakantaris of the Greek TV station ERT, please. Yes, please.
Yes, can you hear me now?
We can hear you from Greece.
Thank you very much, Wolfgang. Madam President, with the winding down of PEP, a degree of flexibility the ECB has introduced into state bond buying will go away. This is particularly important for Greek bonds, as they're not yet in investment grade. Does the Governing Council think that it should be preemptive, clearing out this uncertainty, this lack of flexibility in respect with Greek bonds, and avert unnecessary speculation? Thank you very much.
Well, I think it's really too early and unnecessarily at this stage to discuss, longer-term issues related to PEP and the term of PEP. As I said, it will be discussed at length. We will enter into a process of technical review, in-depth analysis of the situation, and certainly the situation of Greece will be taken into account and addressed specifically. But I think it's premature for the moment to do so.
Thank you. And the next question will then be for Francesco Canepa of Reuters. Francesco, please.
Good afternoon. The first question is about inflation, which was 3% according to a flash estimate. Do you think the balance of risk for inflation has shifted and is now to the upside? And how was this reflected by the discussion by the Governing Council? And the second question is about the fact that many of your colleagues, including Mr. De Guindos standing next to you, have signed letters urging the Commission to implement fully and swiftly the Basel III rules for banks. Your name was conspicuous by its absence. Do you support their call, and including its timing, crucially, because the governor of the Bank of France said the timing of the letter was unfortunate? So I'm keen to hear your view on that. Thank you.
Well, do not worry, Mr. Canepa. There is nothing inconspicuous about my name not being on the letter, because all those matters are addressed by my colleague and friend Andrea Enria, who is, as you know, the head of the SSM. He's the one who has full authority and much deeper understanding of those issues than I do. But I'm not uninterested in Basel III, and I've had my share of Basel III discussions when I was finance minister and when I was then managing director of the IMF. So I do follow these things, and I do believe that there should be proper compliance and respect of the timetable in relation to these Basel III issues. But I will turn to my colleague and friends, the Vice President, who is also very, very close to that. I will address your first issue by quoting, because we discussed this sentence to make sure that we were all unanimously in agreement with that in relation to inflation. And we say very clearly in the risk assessment paragraph, if supply bottlenecks last longer and feed through into higher than anticipated wage rises, price pressures could be more persistent. I don't think we could be more clear than this sentence is.
Now, with respect to the letter, I have nothing. I have not much to add to what you have said, President. Well, the letter was signed by the head of the EBA, by Andrea Enria, and by myself as person responsible for financial stability in the ECB. And, it's crystal clear. The message is crystal clear. We want full implementation of the Basel III. And I think that, that's the position of the three of us, of the three institutions. And as I have said before, we believe that this full implementation, this rapid implementation, will bring a lot of benefits for the banks and for the economy.
Thank you. And the next question goes to Johanna Treek from Politico Europe. Johanna, please.
Thank you very much. Can you hear me?
Yes.
Thank you very much for taking my question. President Lagarde, so when you discuss PEP in December, the economy will have returned, the economic output will have returned to pre-crisis levels. Will that then be a sufficient condition for you to declare the crisis phase over? And then what should we all expect from November? What are you going to do during your November meeting?
What will we do with what?
Your November meeting, given that you are putting so much emphasis on December and
I think
suggesting nothing would happen.
I think it's actually October.
Oh, sorry. October.
Well, we will all get together around the table and we will assess the situation, because not a single monetary policy governing council meeting goes without us looking at the situation, assessing the financing conditions and being attentive to the effectiveness of our measures. So don't worry, I'm sure we'll have plenty to discuss and to review. But as I said, the important meeting at which we will discuss the terms and conditions of the PEP when it comes to its term will be in December. At our December meeting, there will be two things. One is, it could well be that our forecast is actually delivered upon. So we have caught up with the 2 years, and we are back to pre-pandemic 2019 situation, which doesn't mean that we are back to trend of the growth trend that we had in 2019. We are still far away from that in our forecast. And we will have new projections, which will give us a projection not for 2023, but for 2024. So we will have more substance to chew on in order to discuss the terms and conditions of the PEP term. Thank you.
Thank you. And the next question goes to Francesco Ninfole of Milano Finanza. Francesco, please.
Thank you and good afternoon. I'd like to ask 2 questions to President Lagarde. The first, do you fear any kind of contagion from the US in the bond market? And in that sense, will the Fed's decisions on tapering influence your actions? And the second question about fiscal policies. In your opinion, how should fiscal policies be in the coming months? More focused on fiscal consolidation than in the past, or still on supporting economies in an uncertain phase? Thank you.
Well, thank you for your questions. I would preface my answer to your second question with acknowledging that during this crisis, fiscal policy, monetary policy have been reinforcing each other, unlike in previous situation. And the fiscal support that has been extended to all the euro area economies has been critically important. And it has been increased relative to our initial projections. If we look back at what we forecasted in December last year and what has so far been the fiscal impulse and the fiscal stimulus given to the economies, there is a significant difference. It was more than doubled. So fiscal policies have been very important and have supported monetary policy, as I think we have also complemented. So they really worked hand in hand. Our assessment is that the fiscal support has to be continued. And as I said on previous occasions recently, it is no longer the massive necessary support just across the board to all actors of the economy, as was the case in the beginning of the crisis. It needs to be more targeted, it needs to be more surgical, it needs to be associated with the structural reforms that are so much called for and necessary in some countries. And this is really the point about the recovery and resilience plans and the funding that is made available to that effect. That is underway, will continue to be applied in the quarters and years to come in consideration for delivery under the plans, as you know, and we hope that it will facilitate the recovery and it will reduce the risk of divergence between countries and the risk of fragmentation in the recovery process. So a time will come, of course, when this fiscal support will have to be gradually withdrawn and where the rules that the Europeans will give to themselves once they have renegotiated the Growth and Stability Pact, or whatever they call the terms under which they operate, that time will come. But it is still premature, and we believe that a lot of the good results that we are seeing for the economy and the good reason for the recovery has to do also with monetary policy, of course, and we should take full credit for that, and fiscal policies. And this has to be continued because we are much advanced in the process. Recovery has progressed, is rebounding, but we're not there yet. We're not out of the wood. We are not on the green, as the golf players will appreciate. We're getting closer, but we're not there yet.
Thank you. Next question goes to Luke Hayton of Market News International. Luke, please, over to you.
Good afternoon, President Lagarde. 2 questions, if I may. The first was whether the Governing Council has discussed the possible impacts a change of government in Germany might have for the ECB's monetary policy. And the second was five-year forward inflation break-evens are at their highest since 2017, up more than 50 basis points since the beginning of the year, and way more than the shift in inflation break-evens in the US. How much does such a shift affect your perception of the ECB policy path going forward?
Thank you so much. The answer to your first question is simple and straightforward. The answer is no. We had plenty to discuss, and we did not have any discussion on any change of government in any of the euro area countries, I can assure you. The five-year 1.75% number, which, as you noted, is 50 basis points higher than what it was, which is at the highest in a long time, is something that we pay attention to. But it's not the only one. We look at all the forecast, the market survey, the analyst survey, the forecasters' numbers. We look at all of that. And we also look at what other institutions are producing, because we don't want to be data slave. We are data dependent in our policy determination. But we want to have a look at a whole range of such data to make sure that it's not only directionally in the same vein, but that it's also consistent. And we do look at the five-year, but it's not the only one, I can assure you.
Thank you. And today's last question goes to David McHugh of the Associated Press AP. David, over to you. Thank you. Dave, can you hear us? There seems to be a connection issue, so then the last question goes to Victor Mendes Barriera of Central Banking. Victor, please.
Hi, good afternoon, President Lagarde. My first question is in regards to the self-imposed limits that the ECB has on its monetary policy and asset purchase programs, especially, obviously, the APP. It's true that the ECB sovereign bond holdings have been converging towards the capital key, but if the APP is to be increased, which seems likely once the payout expires, the ECB holdings would be getting closer to the issuer limit, to the 33% limit on the outstanding debt of individual sovereign countries. Do you deem necessary to increase the issuer limit in order to make ECB QE programs sustainable within ECB rules? And the second question is, whether you had any update on the impact the pandemic is having on the weaker or highly indebted Southern European countries that are more reliant on ECB support, such as Italy and Spain? Thank you.
Well, on your first question, thank you very much. But those are issues that will be debated in December. So it's not a matter for me to debate the exact limits in any shape or form, or the capital keys. All I know is that we have a mandate, we have an objective, we have a target which is to be reached, and we will have to use all the instruments that we have available. And we will decide on what terms and conditions will apply at our next meeting, and we will adjust accordingly if necessary. On your other point, what I observe is that those nations that were most affected by the pandemic, which are largely countries from the south of Europe, are the ones that are benefiting from the highest volumes of loans and grants under the Next Generation EU. And we very much hope that with the plans that they have submitted, which have been approved, with the loans and the grants that are already being disbursed and will continue to be so if there is delivery in consideration, then they will be in a much better position to respond to the damage that was suffered. What we can observe, though, is that in relation to tourism, in relation to hospitality services, there has been a significant increase in activity, and probably more so than was expected earlier in our projections. Thank you very much.
Thank you. This concludes today's press conference. If you want, we will see each other back on 28 October when the next Governing Council plus press conference takes place. Until then, wish you all the best, goodbye, and have a good afternoon.
Put that one in the diary. I'm sure Dave hopes he gets another shot. From New York City this morning. Good morning, good morning. That was the news conference of the ECB over in Frankfurt, Germany. Let's get to this price action. The lady is not tapering, the words of President Lagarde. Euro dollar off the back of all of this, not doing much, 118.32. Positive by a little more than 0.1%. Into the bond market, where yields are just a little bit lower on the Italian debt market. The Italian 10-year yields in. That's the story there too. Where are we? 70 basis points, down around about 5 basis points on a session. A bit in the bond market too. German 10-year yields in 2 basis points to negative, let's call it negative 35 basis points on a German 10-year. Switch at the board and get to the equity market. The shape of things as follows. For equity futures in the United States going into the opening bell just seconds away, we're negative 0.04%. Europe doing okay. We're down about 0.25%. The message from the ECB president, pretty clear. At least one message was, we'll see you in December.
Concerning PEP, you know, that's a discussion that we will address comprehensively at our December meeting as the term of PEP approaches. We need to obviously discuss the terms and conditions of how that term occurs, and you will hear me again on this matter, certainly at our December meeting.
December 16th for that particular meeting. The opening bell just ringing in New York City with equity futures doing okay going into the opening bell after 3 days of mild losses on the S&P 500. Will we get a fourth? See you in December. What about that battle in December? Take a listen to what Holger Smeeding of Berenberg had to say.
Today's press conference is only the prelude to the really big decision. The hawks will now probably try to sum up all the strength to influence the December decision. In December, the ECB will probably not be able to duck the issue, namely, when does the emergency end?
Setting the stage for the battle on December 16th. Let's bring in Invesco's Alessio De Longis and BTIG's Julian Emmanuel. Gents, thank you for sitting through the whole of that alongside me and my audience as well. Alessio, your reaction, please.
Well, I think it was a relatively calm event, a non-event, so to speak. For the theme that you've been highlighting all day, I think if you're a bond investor in Europe, looking at 100 basis points pickup in Italian spreads, or looking at investing in 10-year treasuries, hedge back to euros, and also there you get 100 basis points of pickup. That seems to me this meeting really delivers confidence to an investor who wants to deploy capital in those pickup opportunities. They're very different risks, but with this level of low volatility, a non-event, those 100 basis points matter a lot to bond investors.
Do you get that confidence as well, Julian?
Yeah, and I think Alessio just nailed it by talking about calm. Look, if you are a global central banker right now with $14 trillion worth of negative yielding debt globally, and valuations in the equity markets, certainly by many measures in the U.S., at all-time highs, price obviously at all-time highs, the one thing you want is to talk and not royal markets. And in that respect, Madame Lagarde did a fabulous job, you know, and frankly, the part of it is due to the reintroduction, the re-emphasis of the word that served Jay Powell so incredibly well these last several months, transitory.
Transitory, the T word we've heard so much of. And to your point, Julian, the North Star for this market, at least from the market's perspective exclusively, is the Italian debt market. The Italian debt market came out of this with yields lower. If that's the litmus test, I don't know, but for many people in this market, it really is. Let's head over to Frankfurt, Germany, and catch up with Maria Tadeo following that news conference. I'm Bloomberg correspondent. Maria, your reaction, please.
Well, you know, Jonathan, we spent weeks talking about the hawks, the Germans, the Austrians, the Dutch, and so on. But listening to that press conference, to me, Christine Lagarde was as dovish as she's been in every meeting during this crisis. You know, she still talks about transitory. She was asked many times about the ending for the PEP program. She always speaks using conditional tenses for that. And then she repeated, we are buying less because the European economy is on a stronger foot. This is about improved financing conditions, and that's the reason why we're we're doing this. She went for the word recalibration. There was no word that resembled or looked anything near like a taper. You know, she was very clear on that. This is recalibration based on good financing conditions. And you alluded to that right there. When you look at Italian bonds, the yield, well, you know, it tells you a whole different story. You know, for the market, this was still very much a dovish press conference. You know, there was no hint of pressure coming from the Germans, the Dutch, or the Austrians. And I came out of that press conference thinking, what is it that the hawks got out of this meeting? And to me, it's very little.
Yields lower by 6 basis points to 69 on an Italian 10-year. Maria, thank you, and thank you for the work through the day on Bloomberg TV and radio. Alessio, if you were to pick and really pick at this, I'm looking at the forecast here for core CPI in the Eurozone, 131415 for 21, 22, and 23. We'll get 24 in December. Should you be reducing the pace of anything if they're your inflation forecasts?
Well, you're raising a very interesting point. For those of us who were around in the pre-GFC world, any inflation forecast that would be below 2% would lead to actually an increased easing stance rather than the other way around. So it raises an interesting question, especially after the strategic review where downside deviations from the 2% target will be looked at in the same negative way, so to speak, as upward deviations from that target. So they're clearly struggling with trying to exit emergency programs such as PEP. But I think that is exactly the tension, is how the APP will be turned into a light PEP version, given its flexibility and potential increase in size to make up for the PEP.
That's going to be a big battle on December 16th. So to go through this, December 16th is the ECB meeting. Also on the calendar, December 15th, the Federal Reserve meeting. The Federal Reserve has got a decision to make on September 22nd before we get to December. This is what Dallas Fed President Robert Kaplan had to say.
I would love to see us sooner rather than later start taking our foot off the accelerator because I think the longer we make these purchases for longer than necessary, I think it may actually make it so that we have less flexibility down the road.
Mike McKee joins us now. Morning, Mike.
Good morning, John. Well, the Fed is somewhat divided on this issue, and the data may be what decides. We look at the Beige Book yesterday, and there are three key phrases from that. One is that economic growth downshifted slightly to a moderate pace in early July through August. We know that happened in part because of the Delta variant. They say dining out, travel, and tourism all took a hit. Does that continue through September? Meanwhile, John Williams from the New York Fed said that he hopes they can taper because the job market will get better. But the Beige Book says demand for workers continue to strengthen, but all districts noted extensive labor shortages, constraining employment and in many cases impeding business activity. On the one hand, that means slower growth, which should be a brake on inflation. On the other, that's leading to what the Beige Book calls strong wage growth. And as for price pressures, the Beige Book says inflation was reported to be steady at an elevated pace, something of a euphemism for, yeah, we got high inflation. There were 29 references to supply chain disruptions in the Fed's latest Beige Book, up from 17 in July, 15 in March. So now the question before the court is, if the growth downshifts, how long will we be in a lower gear? Williams is hoping it changes quickly. Kaplan isn't sure and would like to get on with tapering. Raphael Bostic from Atlanta out this morning saying, while he was a hawk, maybe we need to wait for a little bit more data. As you mentioned, we have the September 22nd meeting coming up, and the Wall Street feeling is maybe they hint there and maybe announce something in November or December. So we've got till the end of the year. We'll see what the data tell us.
They get first mover advantage in December. The 15th to 16th is going to be fascinating later this year. Then it's year over.
I guess
I'll be straight
can't
out the
take
door.
the day off there.
No, we'll take off. Let's take off the 17th.
All right.
For the rest of the year. Mike McKee, thank you, sir. Thank you very much. On this equity market, Gillian Manuel of BTIG standing by. Just want to bring you what Savita Subramaniam had to say to us a little bit earlier this morning, gents. She's gone from 3,800 to 4,250. Take a listen to this.
Earnings have come in strong, but we're starting to see some harbingers of risk. The cyclical pressure of input costs, wages, supply chain dislocation. We're at peak globalization. We're starting to see companies onshore. And what that's going to do is, again, potentially stall or reverse this kind of long-term great theme that we've had for big multinationals. The S&P 500 has essentially turned into a 36-year zero coupon bond.
Love to catch up with Savita and enjoyed catching up with her again this morning. Julian, I'd like your reaction to that. 42.50 year end on the S&P at Bank of America. We're well south of that already right now. Year end next year, they're looking for 4,600. That implies the tiniest of upside for this market. Your response?
I actually think Savita's sending out a reasonable message here. Basically, look, a year ago, we would not have believed that markets could have come this far. Really sort of almost impossible. And now the feeling is that it's impossible that markets could actually correct. And so for us, the question is, how do you as a long-term investor deal with that dynamic? And our view is you stay fully invested. You have very good gains this year if you're fully invested. You should be willing to spend a little bit of it on downside protection because in our view, a lot of these risks, the Fed potentially dialing back accommodation at a time when the economy is perceptibly slowing a little bit, are not properly accounted for within the context of a longer-term bull market, which we think does have further to run.
Julian, I know implied vol is low, but we caught up with Mandy Zhu at Credit Suisse, who has pointed out, and others have too, that there has been a big pile-in for downside protection. Just how expensive is that right now?
It's reasonably expensive versus how the market has actually moved. It realized volatility. You see it on the screen. The S&P moves 6 points a day, 7 points a day. That's very low. But when you look at sort of a multi-year view of where option prices actually are on a relative basis, they are not expensive. And I would point out, John, is that September does have a very reasonable track record for delivering volatility surprises. And although this one has started out on the lower end of volatility, I'd point out that in 2019 and 2018, you actually had a little bit of calm and then a later storm at the end of September into October. We think that's a reasonable expectation.
Does that resonate with you, Alessio?
Yes, I mean, the point from Savita and from Julian are relevant. The bulk of the market really has been driven by quality and growth stocks, where that's where the valuation concerns are. That's where the risk of a flash out in positioning is. And that's why the analogy with a 36-year zero coupon, those are high, long duration assets. So diversifying away more, and this is our core view, into value, into small caps and mid caps, mitigates those valuation headwinds and positions you still for a gradual rise in global bond yields, we believe, without the inflation scare, because we do believe that inflation is rolling over here.
We're going to build on this conversation, Jens. Alessio De Longis and Julian Emmanuel. Let's get you to the market desk. Equities up 0.2% on the S&P with your movers. Here's Abby.
Well, John, indeed, it is the first update, in fact, for the S&P 500 in 4 days. And one stock, a couple of stocks helping out, but Freeport-McMoRan, if we take a look at the natural resource space or part of that reflation trade, we will see that we have gains for Freeport-McMoRan and Alcoa. We have copper and aluminum higher, that helping out those metals and miners. ExxonMobil had been lower. In fact, so had Occidental Petroleum. Very interesting. Energy, the worst sector yesterday, even though oil had been up more than 1%. Oil now down today, and that sector hanging in there. And then, of course, we had highly anticipated earnings yesterday after the bell. Let's take a look at GameStop. It is down sharply, the worst day since June. A 10% decline for GameStop is not huge, but it does meet the eye. Messy quarter, bigger loss than expected, a 5% sales beat, not enough to overcome that larger loss. They also failed to ease concerns. They're not taking questions from analysts, no guidance, price targets taken down. Lululemon, on the other hand, the best day since June of 2018, big beat. It seems that the leisure wear category, John, is still very popular through the pandemic.
Working men, Abby, are wearing Lululemon sweatpants.
I'm sure you're not, John.
I did the channel check. I went into the store and I talked to them about this, and that is a trend apparently, and you are dead right.
Not for you.
Absolutely not. And never will, Abby. Thank you so much. Abigail Doolittle there. Much more from Abby later in the day on Bloomberg TV and radio. Coming up, the president making another big push to get vaccines into the arms of Americans. That's coming up next from New York. This is Bloomberg.
China has been focused for a long time now on catching up to the United States in space when it comes to space exploration, and they've really made a couple of really impressive achievements. For instance, in May, China landed a rover on the surface of Mars. It's only the second country after the United States to manage to do that. In June, China sent astronauts to its space station, which is still under construction. China is not part of the International Space Station because the United States worked to exclude China from that. But instead, the Chinese are working on their own. That's scheduled to be in full operation, I think, next year. The Chinese have really come a long way in space. That said, all of that's run by the Chinese government. There is a role for Chinese companies to play in the space program. They're not being as front and center, say, as Elon Musk with SpaceX or Jeff Bezos with Blue Origin. China's companies are playing a more supportive role, I think it would be a fair way to say it, working on things like satellites, rocket launch operations. They're leaving the really big, sexier items when it comes to space exploration, leaving those to the Chinese government.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We know that increasing vaccinations will stop the spread of the pandemic, will get the pandemic under control, will return people to normal life. That's what our objective is. We want to be specific about what we're trying to accomplish in this moment and what these 6 steps will do.
The President of the United States addressing this at 5 p.m. Eastern Time. Joining us down in Washington is Bloomberg's Emily Wilkins. Morning, Emily.
Morning, Jonathan. Yes, so we are expecting a large speech today from President Biden focused on COVID. I mean, this is an issue that has really been primary from his administration out the gate. Looked like in the first couple months that they were getting it under control with people getting vaccinated, but the Delta variant has thrown a wrench into plans, and there's still a lot of questions going on. White House officials say that now is the time for the speech as schools start to reopen and students go back, as well as a number of workplaces trying to get workers back in at least a couple days per week, and that this is the time to answer these questions. We're expecting the president to lay out a 6-pronged plan that includes putting pressure on private businesses, government agencies, as well as schools to have vaccine mandates. I mean, there is going to be a little bit about masking and social distancing here, but we expect this speech to really focus and hone in on vaccines and what needs to be done to get the 27% of the American population, adult population rather, that isn't vaccinated.
Emily, thank you. Emily Wilkins down in Washington. Have we seen the worst of it? That's the discussion for this market, for economists too. Alan Zettler of Morgan Stanley says we have, that the data was likely at its worst in August. And what does it mean for the airlines as well? This is the story from United Airlines and Delta this morning. United Airlines saying a deceleration in customer bookings in the last few weeks. Delta seeing total revenue at the lower end of prior guidance for the third quarter. And this is what the stocks are doing. They're positive on the day in the early part of the session. Julian, I wanted to come to you on this because we keep getting these negative headlines. And I'm looking at a market, a sector, an industry that responded to some of this back in spring. That's when the airlines topped. And the question I've been asking, and it divides people, believe me, but I just wonder on what side of the debate you're on right now. Are these headlines reinforcing a move we've already seen? Or are they fuel for a move lower still, for something to get worse here?
Well, the airlines as a group, as you know, are very volatile. And as you rightly pointed out, we have seen a rather sizable pullback in the group. And it's not a surprise to us, given the view of some that the virus may be peaking, the Delta variant may be peaking here, that these stocks are trading better this morning. But to me, and it was heartening to see scenes of very full stadiums over the weekend. And, it's our hope that that continues and that doesn't cause the spread. But the next couple weeks of data are going to be very important as kids are back to school fully and as life tries to open up. And I think that's part of the unknown that in general makes the market somewhat more challenging to navigate here.
I'm with you, Julian. I'm with you. It's nice to see. It's good to be a part of as well. I was at Arthur Ashe over the weekend, and that felt good too. And we want to see more of it. We want it to be safe, of course, but it really makes a difference to see people come together again. Alessio, I just wonder from your perspective, what all this means for where you want to take risk in this market and how much cyclical risk you want to take.
Still favoring cyclical risk. This is still an environment where growth is expected to remain solidly above trend. We are going to go through decelerations, but they're not going to be harbingers to real contractions, so to speak. So in this type of environment, still overweight to risky assets, equities, credit, risky credit over investment grade, and a bias towards cyclicals, value, small caps, mid caps. Why? Because we expect rates to continue to gradually rise without a meaningful inflation scare. And it's an environment where central bankers continue to be successful in pushing investors out in the risk curve. So in our mind, the strategy, there will be dips, there will be risks, foreseen and unforeseen. The strategy for us remains one of buying the dips rather than using the rallies to take risk off the table.
Gents, framing the debate in this market right now, it's been good to catch up. I appreciate your patience and your time, of course. Alessio De Longis of Invesco and Julian Emanuel of BTIG. Let's get you some sector price action with this equity market down 0.2 on the S&P, up 0.2 rather on the NASDAQ as well. Here's our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. You've got 7 of the 11 main industry groups in the S&P 500 higher in early trading. Financial stocks leading the way, especially the insurance broker Willis Towers Watson. They're meeting with analysts and investors, talking about financial targets for 2024, and their earnings forecast higher than analysts' projections in a Bloomberg survey. So that's going over well. In the consumer discretionary category, that's where you find the apparel companies like Nike and Under Armour. They're higher after well-received results out of Lululemon Athletica, not itself in the S&P 500, actually based in Canada, nonetheless influencing stocks in the S&P 500. Where you're seeing weakness, looking beyond the index, is in these Chinese game companies. Now, you had regulators basically sit the businesses down at a meeting and say, you got to focus on something other than just trying to make as much money as you can. And, it's definitely showing up in terms of the Golden Dragon China Index, which tracks U.S.-listed Chinese companies. Had shown a bit of a recovery lately, though. It's tailing off today, as it did yesterday. And what's happening with the video game makers definitely having an effect.
Dave, sweatpants in the office. Your vote. Yay or nay?
Not a chance,
I'm with
John.
you, buddy. I'm with you. I'm with you, not a chance. Dave Wilson, our stocks editor, on China too. We'll pick up on that story tomorrow on Bloomberg TV as we go into the weekend. As we go into the weekend, much more still to get through this Thursday. Up next on the program, your market-moving events that you need to be watching in our trading diary. Right now, 22 minutes into the session, let's call it 23. Your equity market's doing okay, advancing just a little bit on the S&P 500, up 10 points. We advanced 0.2%. Treasuries stable, yields lower by almost a basis point. Let's call it 133 on 10s. From New York City, this is Bloomberg. the session started and wrap up the trading week.
News.
Who knew that one earnings story could tank the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What is making me really nervous today is that there is this like accompanying surge in deaths as well.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
"25 minutes into the session this Thursday morning. Good morning. Stateside in New York, we advanced by about 0.2% on the S&P. Similar move on a NASDAQ, up about a third on the Russell. Unchanged, finding some stability after a messy couple of days. That's the equity market. Switch up the board and get to the bond market. A bit of stability there too. In and around 133 on 10s. Yields in by, let's call it half a basis points on 10s, on 30s, on a 30-year. 195, 194, 95, and on a 2-year, about 22 basis points or so. That's the equity price action, a bond market price action too. It's your trading diary, what you need to be looking for through the next 24, 48 hours into the weekend. The Fed speak, San Francisco's Mary Daly and Chicago's Charles Evans kicking things off for us at 11 Eastern, plus Bowman, Williams speaking throughout the day. Then a little bit later this afternoon, a 30-year auction, $24 billion worth. The president will be speaking at about 5 p.m. Eastern. And to round it out, we'll hear from Fed President Loretta Mester on Friday. And finally, rounding out the week on U.S. PPI numbers and wholesale inventories. Going into the weekend with a little bit more work to do. Your equity market is doing okay this Thursday morning. From New York, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Last night we were at a dinner at a restaurant,
And as we were walking out, a man walked over to me and said, "Thank you very much. You paid for my daughter to go to college." And basically, I get that all the time. It's the most unbelievable thing. That's my job.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens.